to order. It is June 9th, 8:30 a.m., and we'll call the meeting of the Board of Investments to order. And please, everyone, remember that we are recording this. So we'll begin with the roll call.
Paul England.
Here.
Mark Nonig. Jack Prothero.
Here.
Terry Cohey.
Here.
Bruce
Dana,
Nelson.
you're kind of choppy.
Here.
Diane Fladmo.
Here.
Maggie Peterson.
Here.
Jeff Greenfield.
Here.
Jim Edwards.
Here.
Senator Thomas. Representative Hamilton.
Here.
Does anybody have any public comments for the board? Seeing none, I think we are at tab 8. Jim from RVK, quarterly investment performance analysis, correct?
That is correct, Mr. Chair. And if you're ready, I can start. My colleague Becky may bounce in partway through, and then she'll hand it back to me. That's the plan, anyway.
Morning, everyone.
Hi, Becky.
That must be
Hi.
great. So, just a couple scene-setting comments. I talked to a wise man once, and he had a foolproof investment plan. And the plan was, whenever there was a really awful quarter, he just simply didn't open his statements. But since I'm obligated to open your statement and talk to you about it, I'll do so, because it was a really ugly quarter, and particularly all concentrated in the last month. Just a couple scene-setting numbers. The S&P 500 was down just under 20%, 19.6%. Small caps in the U.S. did much worse. They were down over 30%. The international stocks, international developed stocks, were kind of in the middle, worse than the S&P 500, but considerably better than U.S. small caps. Bonds, as is typical for these types of situations, not always, but not during the GFC, but during this period, we're up 3% as interest rates fell. And as we discussed yesterday, one of the challenges going forward is interest rates have fallen across the entire yield curve. And the yield curve, again, starts with 3-month paper all the way out to 30-year paper. And the entire yield curve fell. So there is no place to go in terms of extending your duration to get better numbers. And in fact, at the end of the period, virtually the entire yield curve was under 1%. So big challenge to folks trying to invest conservatively, but also try to fund benefits or whatever the purpose of the fund is. So if I could turn, and John, I understand you're in charge of the pages. The other book. Oh, okay. There we go. We'd like to go to page 7 if we could, John. This is the main page that talks about the performance of the total fund. These are the numbers that are essentially the sum of all the major decisions like asset allocation that you make, and less important but nonetheless meaningful decisions that you make in terms of manager selection. Page 7 of our page 7. Yeah, quarterly investment performance. Nope. It should the page.
So not the web book, but the full book.
You're on the summer. I'm on the full quarterly performance report.
Yeah. Section 2.
That's the yield curve that I was talking about. But now I've moved to the big quarterly report. It is titled Oh, okay. Must be somewhere.
That may be the web book that you have up.
It says
Instead-
quarterly investment performance analysis is the title of the.
We've got it. It's tab 8.
Right. Section 2.
And page 7 should have public employees retirement net on the upper left-hand corner, and it goes down through a number of your clients, teachers retirement, police retirement, and so on. But it has the 1, 3, 5, 7, 10, and 20-year numbers across the top. Then on the right-hand side, it has individual years. And we typically focus on, that looks like it. And that is some different page, but it's page 2 in your book? Okay. Oh, okay. Great. So it's page 2 in John's book. John is all in his own universe here. All right. So as is in the past, we don't like to focus on an individual quarter because, as we discussed yesterday, quarterly numbers bounce up and down and up and down. What you really want to know is what the trend line is after all of those ups and downs have been settled out. It's a little bit like trying to judge a baseball player by a single game. Might go 4 for 4, might go 0 for 4, but it doesn't say anything about how he's going to hit over the course of the year. You have a question, Terry? Oh, hey, that's the chair's job? Jeez.
That's the vice chair's job.
There you go.
But as we discussed yesterday, every once in a while there's a very unusual quarter, and try to see if there's any information that can be gotten from it. So let's talk a little bit about the quarter itself, and with respect to the 3 benchmarks that you should think about as a board when you look at the total fund. This is the total fund you're responsible for. The first is that actuarial goals, and we'll talk about it in the quarter and beyond. Actuarial goals fell far, far short of that goal. 7+%, minus 11.21%. We're using the PERS number at the top. They're all the same because of the way you calculate you serve your clients in terms of returns. So that's a difference of almost 18% on the adverse side. That's a big difference. So with respect to the quarter, it was not a good quarter for the capital markets opportunities that any institutional investor had to fund benefits. Now, every time that there's a bad current period, it does have a ripple effect back through the history, just like when there's a good one, it does. So one of the questions that we would say is that, well, when we look at the longer term, 3, 5, and 7 years, for example, is the current quarter so unusual that those longer term numbers have been affected enough to be a bit distorted? And we would say not necessarily so, particularly when you look over 5 to 7 years. But one of the things we'd say, again, going back to the benchmark about funding benefits, that those 6.24 and 7.32 numbers are still a tad short of what is expected by the plans to fund benefits. And when I say expected by the plans, it's a benchmark that you choose because you're in the process, you're setting contribution levels based on that. So, and as you can see, as you march to the left, we have actually been, even though just over the last 10, 12 years, we've been in a fairly good equity market, the overall total returns have actually been declining over time, the absolute returns. So the challenge of meeting the actuarial benchmark isn't getting any easier, it's getting harder. The second benchmark that you might use is not to say how are we doing in terms of the expectation by the plan based on where they've set contributions of what they hope to get from the capital markets through the portfolio. The next one is, well, let's put that aside for a moment and ask the question, the board has set some goals for itself, and that's embedded in the policy portfolio. That is the portfolio that has all of your benchmarks for all of your asset classes, and they're rolled up into a benchmark for the portfolio. This is your essentially execution benchmark. How are we executing against our own expectations, not the plan's expectations based on contribution level selection, but rather our own investment goals? And the answer here is that the quarter, oddly enough, was spectacular. I mean, spectacular. Almost 13% ahead of the policy benchmark. As we discussed yesterday, that is a heavy distortion. And it has to do with the fact that we're seeing the mirror image, as I said yesterday, of the lag in private investments. They appeared untouched. The public markets went down. So when you combine them together, you're blowing through your policy benchmark. And I wouldn't take great comfort from that. Just as we said, when you were lagging your benchmark during a very rapidly rising market and your private investments weren't being marked up as fast as the public market, we cautioned you not to feel like the portfolio was not performing well. And this is one of the reasons why I said yesterday that it probably would be better if you wanted to focus on short-term numbers to focus on the current quarter when it's available, and this quarter, at least they look like they're mirror images of one another, and there should be some washout. But the most important message here is that you want to, with respect to answering the question, how are we executing against our own investment benchmark goals, to have a longer term horizon. Now, this number is so big that there is some distortion back in history. So you look now, and all of a sudden, your 3-year, your 5-year, your 7-year are all well above your policy benchmark. We would say, let the current quarter wash out a little bit and then make a judgment about what the longer term performance is. I don't mean to be a sort of down on these terrific numbers versus your policy benchmark. I just want to caution you that unusual quarters like this can not only affect the quarter's numbers, as you see here, phenomenal outperformance against your benchmark, but they have a feedback through the history because now they are part of that history. Best to let that wash out.
Are you saying that all of the outperformance of the benchmark is due to private equity?
Not all of it, but a very substantial part of it is private investment, private equity, and private real estate. You disagree with that, John? Okay. So the third way to ask how are we doing, how's the portfolio doing from a fiduciary's perspective, is to say, how are we doing in the business that we're in, institutional investing, versus other people that look like they're trying to do the same thing. Now, trying to do the same thing, peers, is a slippery situation because they have different liabilities. Some of those plans are not cash flow negative. Some of them are. Some of them are extremely underfunded. Some of them are very well funded. Some of them have very strong contribution policies. Some of them have weak ones. And that all figures into their asset allocation. They have different risk preferences by the fiduciaries. So when we get to it is too easy to think that, oh, there's 25 or 30 peers. There really aren't. There are 25 or 30 folks, institutions, that are generally trying to do the same thing you are. And it is not useless to say, how are we doing versus them? But you don't want to hang too much weight on it. And we've said that before. It's the third and least dependable measure of how you're doing versus what you care about, which is your own investment policy portfolio and, of course, your own liabilities, which are measured in your actuarial expectations. But in this respect, you once again came in above median. You can see that number of in the recent quarter of 44, and you look back over the trailing numbers. back to 1, 3, 5, 7, 10 years, and you have an excellent track record against those folks out there that are peers, small p, trying to do something very much like what you're trying to do. And you should be encouraged by that, but it's not the most important comparison. This is a pretty unusual situation, and I hope that it provides a little bit of counterpart to the discussions that you've had about your private investment benchmarking and how it affects these what are called time-weighted rates of return. One of the things that we would encourage you to do is when Ethan or Michael present, take a hard look. We talked about secondary benchmarks yesterday. Take a hard look at internal rates of return, which is a way of looking at the performance of private investments that over a long period of time pretty much comes out to be the same as this, but over a short period of time gives you a little more information about private investments versus when we have to convert them into a measure that is compatible with all your public investments. So any questions about the performance of the total fund? Okay. So maybe, John, we could turn to page 10 and talk a little bit about the most influential by a wide margin aspect of the portfolio and your investment program that determines how you do vis-a-vis these three measures. And that should be the one that has floating bar charts at the bottom that show your asset allocation versus peers that we draw.
Yeah, I don't think it's in this book, John. This is the web book. The full book is what's got the bar charts, which I think is in your folder.
Okay, I'll talk a little because the being able to see the numbers is not as important as the message. And the message is that you are in the top quartile, although just barely in the top quartile in terms of how much of your portfolio is allocated to U.S. equity. This is an allocation that has served you very well for a long period of time because U.S. stocks have outperformed international stocks by a significant and fairly consistent margin. And you have not quite twice as heavy a weighting in U.S. stocks as you do in international stocks. As of the end of the quarter, you were in the 22nd percentile in terms of the range of allocation to U.S. equity as a percentage of the total portfolio among 53 other pension plans, and at almost 29%. And you had 15.6% in international equity. So you were heavily weighted to U.S. equity and continued to be so. Despite the fact that international equity by historical standards is much cheaper, but U.S. equity continues to outperform, as we talked about in the quarter, the S&P 500 still outperformed developed international equity. Now, when you add together U.S. equity and international equity for both you and the median performers, you are also more heavily weighted toward equity. You have over 44% of your portfolio allocated to public equity. The median of these 53 other pension plans is just under 38%. Again, that's something that has served you well, but it also tends to, because equity is the most volatile of all the major asset classes, it can introduce a lot of volatility in your total fund. You tried to dampen that by a substantial allocation to real estate, where you're almost in the top decile in terms of the percentage of assets allocated to real estate. The average fund in this 53 fund sample is about 6%, and you're 9.7%. Now, that can be a little misleading because you don't do hedge funds. There are several other exotic categories you don't do, like international fixed income, although you'll have a educational discussion on that today. So, the percentage that you have allocated to real estate as one of your main, if not your main, counterweights to your equity exposure, along with fixed income, seems high, but it really reflects the fact that you've chosen not to do some of these other asset classes. Your fixed income exposure is much closer to norms. You're about 26%, and the median fund is about 24%. You're a little bit more, and again, it's part of that counterweight to heavy emphasis on U.S. equity. I said yesterday, and John, if we are able to bring up page 12 of the big book, it would be terrific, because that's the picture that I was talking about yesterday. So on the upper left-hand side of this page, you see what's called the cloud chart. And in past, I've said this is a good consultant's one of their favorite charts, because they don't just focus, this data doesn't just focus on returns, and it doesn't just focus on peers. It focuses on risk, returns, and peers to the extent that there is such a thing as a peer. And so it has more inherent information. Plus, it really can only be accurately calculated over a period of at least 5 years. So did this chart grab our attention? This is the one where I had to email our team, and they politely and diplomatically said, Jim, pay more attention. And so I did. And notice that there are two colored dots on this. One is your actual portfolio, which is the green diamond. And what the green diamond says is that you had risk that was volatility risk that was almost dead center on what this group of institutional funds experienced. So no unusual risk evident in this, and it's above that horizontal line. That's why your peer ranking is as good as it is. This is a good number. This is a good place to be in this cloud chart. Risk, reward, peers, great. So what is that blue dot that's way off there to the right and in a bad spot? When I say bad spot, this quadrant is defined as a section of risk reward that has way more risk and less return. And guess what it is? It's your policy benchmark prior to the changes that you've begun to make in it. And why is it there? Because all of your private investments have been, in the past regime, marked to the public markets. And so your policy portfolio, you can see how differently it behaves than any of these other peers. I mean, this is a monumental space that has opened up between your policy portfolio, because in your previous regime, the emphasis on investability also meant an emphasis on high volatility in your benchmark. And here it is in spades. I mean, when I saw this picture, it was so big. That's why I had to email the team and say, is it really that big? And they emailed back, Jim, pay attention. So I did. So I hope that's instructive to you, because it gives you a picture of, we had this great discussion about benchmarks yesterday. You can see how different the focus that you've had the last 3 years or so on benchmarks has made you different. And different is not always bad, but it's made you remarkably different than the rest of the peers in terms of how they are likely to be benchmarking their portfolio. And this chart really just brings that home.
So question, can we do questions now? Okay, so Jim, when we talked yesterday about changing that benchmark, when we look at this the next time, will that change that we've?
A little bit. Remember, this is a 5-year calculation. So
Okay.
you're going to capture some of the old regime until it finally washes out. But that policy portfolio volatility should gravitate closer and closer to where the norms are. As you continue to work on, as Dan discussed yesterday and John, your benchmarks to try to make them more representative and more aligned with CFA Institute standards, and in the process, less volatile.
Questions?
Jim, it seems that over time, that when we've looked at these charts, we are moving more and more out of the upper left-hand quadrant. Is that, first of all, isn't that true? And secondly, why?
The answer is yes. If you look at the one below on page 13, you can see that it's not as big a movement as you think. So if you look at page 13, which is the one that looks over 10 years, you can see that your volatility, actual volatility experienced over 10 years still stays right in the middle of the pack, but your performance remains well above. So it would be nice to be even further into that northwest quadrant where Montana is. But this is a good cloud chart. It means that you are getting compensated for the amount of volatility that you're introducing into the portfolio, the actual volatility, not the volatility that's represented by the benchmarks that I just talked about.
Jim, why is there not a public employees benchmark circle on the 10-year?
Because you've made so many changes. It's not meaningful. NA means it wouldn't have a lot of meaning because you made such big changes in the prior regime.
Yeah, your new benchmark, Terry, was actually incepted well after the beginning of this period, so we don't have that full 10 years for the benchmark with all the benchmark changes that you're looking at moving away from. So there's just not a complete history for 10 years.
But we will have one. We will have one. And Mr. Chair, your comment about being in the northwest quadrant is spot on. That is the most wonderful place to be, because just as the lower right-hand quadrant is defined as a lot more volatility but less return, the northwest quadrant, upper left, is defined as I took less risk, at least vol risk. There are many kinds of risk, and I got more return. So that's a wonderful place to be, but there's nothing wrong with the place that you're in. In fact, it's a good place.
So, Jim, data seems like something we can manipulate in a good way. Is there a way
We don't
to
usually use that term.
Yeah. I'm the guy who has to answer the question, what's 2 + 2? Somewhere between 1 and 5. So is there a way that we could take, because the policy benchmark we have, it has fluctuated, but is there a way that we could take the performance of that policy benchmark and look backwards? And I say that in the context of, I think our current investment regime is going to be very closely aligned, more so with sort of that top decile performance we had post-Great Financial Crisis. Is there a way that we could sort of plug that in absent the benchmark changes that were made for a 4 or 5 year period?
The answer is yes. Statistically, we can hypothetically create a different policy benchmark history. No question about that. It takes some work because we'd have to imagine that all the changes in the past regime that took place didn't take place and recalc that history. But, that's just roll up your sleeves and a lot of work. The real question for the board is, and one that we say when people ask us this, is that is the history, and so, we always caution, because we're looking out for you. We don't want you to be subject to criticism that you kind of change the goalpost retrospectively. But yes, we can do those numbers, and yes, we will do them if you ask us to. But it's a careful, we would caution careful thought about how you use them. Is that a fair?
Absolutely.
Okay.
If I can.
Question.
So we've made a couple of changes here recently. So core fixed income as an example. We put core fixed income, back into the ag-like portfolio recently. And when we did that, we kind of lost some performance. We have a long history with core fixed income, but we didn't have sort of that benchmark performance. So we have asked State Street, and they have done it. We didn't have a chance to kind of get it to RVK before this meeting, but we have a history of core fixed income, kind of both, I'm going to call it pre and post cap, if you will. And so we're not rewriting history because we're using the benchmark that we had at the time that we had it. We're just rolling all of that together. So we'll have some longer term numbers. The two that stood out for me were core fixed income and non-core fixed income.
Mhm.
So we kind of had some very short time frames in there. Now, I don't know if that's included fully in this analysis or not, but when you look at some of the underlying portfolios in the RBK book, we don't see some of that longer history for this quarter. But we've asked State Street to sort of recreate that for us. And again, not rewriting history because we're using the benchmarks that we had at the time that we had them, but just to see that performance over a longer period of time and recognize that we, either did or did not outperform the benchmark, which I think will help this a little bit as we get that info to them and we can kind of tie that back to some of their analysis.
And I think that's a process that is not subject to the criticism that I was concerned about before, what John just described. Those are actual results, actual investments against an actual benchmark. That's not, that is targeted toward the performance of those investments per se. So I think that what John just described is a different animal than what we discussed.
So
Was there-
I've got a question, and first want to say I said at least a couple of things yesterday that made absolutely no sense. So I'm going to try to do better today. But
I
what-
thought I was the one not making any sense.
no, Jimmy, you did fine compared to me. So, but what would that projecting back get us? I mean, I'm a little concerned about this, not only in terms of what you're talking about, Jim, the appearance that we might be trying to change the goalposts, but I mean, what could possibly be useful out of that for us if we decided to do it?
Well, I can think of two things, and that's a very good question, by the way, because number one, you can't change history. The investments did what they did, which were good, and you benchmark them the way that you did in that regime. That's part of history. But looking back can do a few things. One is that it can give you a little bit better clue as to how the reconstitution of your benchmarks going forward, you have a test case, if you will, to look at how the policy portfolio, your benchmark, would have performed during this period. Right now, you don't have that. It's a gap in your knowledge. So it does carry information to you that may prove useful. So I don't think it's a useless exercise. I think it does carry information that may prove useful going forward. But it is what it is. There is history is history.
And Bruce, maybe to add to it, I think the color that it gives us internally is something that would add value. Externally, we can have conversations about benchmarks as much as we want inside this room and on these meetings. The only benchmark anyone outside of here cares about is 765 and 75. So to the extent we get some color internally as to whether or not the reconstitution of the ag portfolio and the changing of the benchmarks away from solely the eye of Samurai adds value to us internally, I think we can garner some information from that. Externally, we're going to be measured against two numbers, and that's all that is going to matter.
Okay, thanks, Jim.
But isn't it,
Thanks, Jan. I appreciate that.
but isn't it also true that one of the lessons we learned from the chart on page 12 is that we went through a period where our benchmark had high volatility in it, correct?
Correct.
Okay. And so if you had that same chart projecting back with our current benchmark, then we would also be able to tell if our current benchmark had that same,
Or the one that you're trending toward.
right,
Yeah, you're still in the process.
right.
That is correct.
And would that tell us something about how wise we've been at selecting our benchmarks?
Yes. Well, at least with respect to, yes, it will tell you whether or not you've selected a benchmark whose volatility is remotely even close to the actual volatility of the portfolio. That is absolutely true. And so that's the piece of information that I was referring to that might prove useful to you. By the way, should anyone criticize you, if you were to move in that direction and do a complete reconstitution, finish your process on your benchmarks, then ask us to do that recap, this quarter would not have looked like a quarter, the incredible blowout quarter that it was, because your benchmark again is being driven down by a lot of stuff and a lot of more volatile stuff. So it would still look good, don't get me wrong, but it wouldn't look like a moonshot, a positive moonshot that it looks like today. So, you know,
Okay, good. Bruce, did you have anything else?
No, I'm fine, thanks. Danny and Jim did a pretty good job of filling in the blanks for me there. Thank you.
So, Mr. Chairman, go ahead.
Yeah, Mark.
I just wanted to make sure I understood, because it seems to me it would be beneficial, if I understand what the proposal is that take the current benchmarks which have gone through, at least with regard to real estate and private equity, some changes, and use those to demonstrate with a graph something like this what our actual performance versus the performance of the benchmarks we now have. I would like to see that if that's what I understand you're saying.
That's what we understand the exercise would be. The only thing I would suggest is complete the reformation of your benchmarks first. Dan mentioned that there were two others we discussed yesterday that are still under consideration.
Fair enough.
So that we only have to do this once. I mean, we'll do it as many times as you ask us to, but
No, that
probably
makes perfect sense to me.
Okay. So I have one more page I want to talk about, and it's page 19. It's titled, it's John, it's this one. It's the equity beta page that's the one. And then I'm going to turn it over to Becky here for a moment. I mentioned yesterday that, and in all the meetings that we've had with you, we like to focus on this page because this is kind of the ultimate roll-up page as to how much risk you are taking versus the inherent risk that's being driven in the stock market. So this basically says how sensitive is the total fund that we have to the U.S. stock market alone. So I would call your attention to the dashed green line, which is all of your major asset classes, the total portfolio rolled together. And every time the market does something, we measure what your portfolio does, and we ask the question, you know, is it going one for one, which would be a number up like where the blue line is. That's U.S. equity. It better be close to one, right? Because it is the market or something very, very close to it. And as you can see, the diversification that you have put into the portfolio has since roughly 2009, the bottom of the GFC, the Great Financial Crisis, you've had your equity beta under control. And in fact, in recent years, it's been well under control. And I think it's one of the reasons that you weathered the quarter so well. We talked about diversifiers in real estate. We talked about diversifiers in fixed income. You know, this is a good sign that even while you have benefited from more equity exposure than the median fund and more exposure to the U.S. market, which is what is being modeled here, you've still kept your sensitivity of the total portfolio, you know, within bounds, within good bounds to that. This is, in some respects, this is one of the most important risk measurement charts, risk monitoring charts that you have in your quarterly report, and we present it every time. And as you can see, things like core fixed income and real estate have very little correlation to the U.S. stock market, whereas international equity, which is the yellow way on the top, has a widely varying relationship to the U.S. stock market. Sometimes it amplifies its changes, and sometimes it's below the volatility of the U.S. market. So this is a chart that is one of our favorites, and because it gives a trend line, it's not just a snapshot. It tells you where you've been over a long period of time and what's happening. Dan, you had a question?
So, well, for both you and John, would some of that uptick have been anticipated given that we knew we were going to be drawing down on fixed income from where we were? I mean, we were extremely high last year. We set the midpoints. We've used that cash to buy more assets. Was some of this uptick planned, or was in large part it just a reflection of the market activity?
Well, I'll let John answer the question of whether or not the incremental changes in allocation might be a factor. They could very well be. But I would also point to the kind of, I guess it's burgundy line that denotes real estate. And notice that it had an uptick. So I think that is one of the factors too. That's a pure market issue. And as we know, the real estate market has had some stresses imposed on it by changes in the real economy, the Amazon effect, for example, and so on. So it's not a big change, and it's not necessarily a permanent one. But I think you sharp eye, and I would say it could be a combination of those two things. I don't know, John, if you had anything you wanted to add to that.
Yeah, so my guess here would be is that, yes, it's partly that we reduced our cash level to some degree, and so that had an impact. I would also say that it is likely that over the course of the last, few years, we put things like REITs, for instance, into the real estate portfolio. We put MLPs in the natural resource portfolio. Those moved quickly with the market move here, as opposed to private real estate that isn't being revalued. To the extent that we owned REITs, those were being revalued and were some of the worst performers during the quarter. So it's probably a bit of a combination of the two, not huge weightings on any of those things. So that would be my guess there.
So two final comments before I turn it over to Becky, and one relates to Dan's comment about there's only one number that matters, and that is each and every year, each and every quarter, did you make 765? It is the benchmark that you have the least control over. It is the one that the market has the most control over. In fact, by far the most control. So when you look at not being able to, in a particular period of time, whether it's 5 years or whether it's 1 year or 1 quarter, not making the actuarial benchmark, odds are extremely high that this is a market effect and that no institutional investor is making a bogey anywhere close to that. When you get down to the policy portfolio, that's much more in your control. You know, when you get down to peers, somewhat in your control, but of course what peers do matters. But the one that is least in your control, that I would agree is the most important one, because it's the one we start off our conversation with always. It has the least, you have the least influence over it just by the nature of what investing is. So I will, the other thing I wanted to say about real estate is that, you know, John reminded me about the lag. Real estate actually did pretty well in the quarter, but as properties get reappraised over the course of the year, and you have a real estate expert in Ethan, you can ask him about this process and what his expectations are. But we don't expect tremendous absolute performance out of real estate in the current environment for the next 2-3 quarters at least. So I wouldn't take too much solace in the fact that the current quarter real estate actually looked pretty good. Absolutely.
Can I ask a question about that? Because in if you look at page 18, if I understand it right, in the current quarter, fiscal year to date, 1 year numbers, real estate isn't looking all that good.
Well, compared to what? Compared to equity, it looks phenomenal. But compared to the benchmark for this 1 quarter, it doesn't look so great. And that a lot of that has to do with the composition of your real estate portfolio versus what is in this benchmark. Again, I wouldn't worry too much about the quarter per se. What I'm focusing more on is that kind of negative number, whether it's negative or close to zero, is probably what you should expect for the foreseeable future, or short-term future looking forward, simply because of what's going on in the real estate market. And this is not a comment on your portfolio, it's a comment on the market. As appraisers work through impaired properties because maybe their vacancy rate is up, or maybe they've had to make concessions on new leases to get people back into offices and so on. You know, we don't have high hopes for the absolute performance of real estate for the moment. When the chair's that close a reader, you've got to be on your toes here. With that, I'm going to turn it over to Becky, and I think Becky would like to talk about page 17. It's the CAP, and it is the major asset classes. I think she's got some comments about the performance of each of the major asset classes, or at least the ones she wants to focus on. Becky, am I right about that, or am I off base again?
No, you're right on base. And Mr. Chairman, I would like to go ahead and focus us at the top of page 17. There's some really interesting themes here, at least to me. As you look at the domestic equity performance, obviously Jim yesterday talked about what was happening in the equity markets and made some comments today as well. You can see the relative performance compared to our custom index for long periods of time is showing underperformance there. This isn't the whole story. I will have you on the next page look at some additional sets of considerations, but active managers struggled during the downturn as well as in the past several annualized year periods to try to outperform the benchmark. So the next page will actually show you, and we'll get there in just a moment, that you ranked very well relative to your peers. So although you underperform the index and you have a lot of money in indexing in US equity, more than 2/3, about 70% or so, you still underperform the benchmark, just like all other plans or many other plans that are also public funds and other types of investors in their equity portfolio. So take that negative difference column for many of these annualized periods with a little bit of a grain of salt, and just know that the index has been very difficult to beat for several years now. The international equity is the opposite. You'll see that you outperformed very nicely. You had some good manager outperformance occurring here. Over time, it's performed very well compared to the index. Yet when I show you the next page, you'll show that peers, it doesn't stand up so well because some other peers took a little less in emerging markets, a little less in international small cap. And those areas have lagged for a while, specifically also in this quarter, and had a big impact on long-term results. But versus your benchmark, you did very well. So it's a little bit of a conundrum when you think about that. So again, domestic equity underperformed the benchmark, but I'll show you on the next page, outperformed peers, is largely indexed. International equity has less indexing, a better manager relative performance. You've outperformed your benchmark, but because you had some of these other value-added segments like emerging markets and small cap, actually was a bit of a drag on your performance relative to peers. Again, I'll show that to you on the next page. Fixed income, you can see the long-term history here of fixed income in that third horizontal blue row. There isn't an index assigned to it here. That will be changing per the comments that John was making about the request of State Street to recast some of these composites. The new composites, which we're breaking out core and non-core separately, follow, but just a very short period to evaluate them. Now, when you just look at the absolute returns of core and non-core together, you can see, as Jim said in the market comments yesterday, the positive performance in fixed income, but it was not positive in high yield. It was not positive in corporate paper. The things that really drove positive returns were treasury exposures. And a lot of programs had performance that lagged the index because they didn't have enough of that high quality paper when investors were so afraid. Spreads blew out, and any kind of fixed income oriented risk that wasn't treasuries got punished. And actually that flows through to the negative numbers you see in non-core fixed income. You had that loss of 11.6% in the quarter, better than the benchmark. You have a better quality portfolio than the benchmark. And you can see you did outperform it for the quarter, for the fiscal year to date, as well as the 1 year, and basically right on top of it for 3 years. This is, again, net of fees. But if you think about the shape of the beta chart we were talking about before, just before we turn to this page, we found, and investors were reminded, as they were in the great financial crisis, that credit exposure acts somewhat like equity when there is a big risk-off event, like there was in the quarter, like there was in the GFC. So you see losses here in fixed income that really had some equity and embedded beta in it. And actually, if you look at the beta trend for fixed income, it actually ticked up a little bit in the quarter because of that. But again, over the long term, investors do pursue non-core fixed income to have a better yield than what they can find in core fixed income. Natural resources, when you're looking at the big red negative numbers in the near term, there's been a lot of discussion already in this meeting, both today and yesterday, about this benchmark. It has a lot of volatility in it. You have some private investments. You have a much different portfolio overall than the index we're using here, and big outperformance. So all the caveats you've already discussed, I won't repeat here, but large negative numbers in terms of absolute returns of natural resources, and that carries out now to 3 years with the big downdraft we saw in the quarter. Real estate, you've talked a little bit about already. Plans, when we look at other public funds, we will see that our structure is a little bit different than some other public funds, the extent to which they had more just Class A buildings and what we call core real estate versus higher return expectations for more development or more specific property types. The latter type of real estate, I think we'll find when valuations are done, and they haven't been done yet, largely for investors across the country, those will take a bigger hit than just those core properties, but we'll expect to see some valuations probably that are going to come in with some red ink for the next few quarters. But the fact that you've got this loss here of 2.7 and a history of positive returns versus the benchmark, which you talked about yesterday, which will be changing, the REIT benchmark behaves with the equity market, as John was saying a moment ago. So again, a big positive difference here, showing you massively outperformed. And whereas your performance has been good, it's just a performance benchmark mismatch. Cash refreshingly had a positive return, as you can see, and has through history. It's just that yields now going forward are very, very low, and we can't expect a lot of productive returns in this portion of CAP because, again, interest rates are extremely low due to the actions of the Fed. And then finally, private investments largely are not mark to market. With the small cap benchmark here, you can see the big outperformance you've already talked about, but a very good long-term successful record And just looking at returns of private equity and private investments generally compared to a market benchmark like this is always going to provide a lot of noise, like we say at nearly every meeting. But here it's just a big mismatch where the small cap market was hit very hard in the first quarter, has come back a lot as we look at numbers through June. But it's what's really providing that big difference column that looks terrific at the bottom of the page. The next page is the rest of the story. And the rest of the story is how do peers perform relative to your various asset class composites. And when you look at the top, you can see what I was meaning about domestic equity versus the median public plan US equity and the rank that you have with a very highly indexed program, even with the underperformance versus the benchmark that you saw on the previous page. Note the long-term favorable ranking. So it's almost a tale of two cities. There's two different themes going on here. So relative to peers, your highly indexed program held up very well. In fact, just missing the top third of other plans in the quarter. And over the last 10 years, just missing the top third in the 36th percentile. International equity, for all the reasons I mentioned on the previous page, relative to peers, with the addition of international small cap, which got hit like the domestic small cap market did in the quarter, and emerging markets, which has been trailing, but long-term investors tend to think is going to outperform the developed world. You can see here that our ranking has been poor, and that's been going on for quite a long time. It also has been going along for quite a long time with other clients that we work with who have a program that includes emerging markets and international small cap. So nothing wrong with your structure here, just a little different than some of the peers. And if you remember the theme from the previous page, you've been outperforming the benchmark. The next section is your fixed income. It's the combination of core and non-core, so you can see that longer term history. We didn't have a longer term benchmark comparison on the previous page, but we show you here the median public plan US fixed income segment. You can see that your nearer term ranks have been very good. Longer term have been about median when you look at 10 years in the 52nd percentile. So that's an interesting result, but you know, during this crisis, your fixed income is ranked pretty well. And your core, which we only have that quarter for in the next blue line down below, ranked in the 17th percentile compared to about 72 other public plan fixed income portfolios. We have the trust funds pool, which again, you see a lot of details of the trust fund performance previously in this performance report, but we show you here the pool, the broad pool that those participate in, and because that is fixed income oriented, we do show you a rank compared to that fixed income segment. And previously, having some of that high yield and real estate exposure has helped that relative performance. And then finally, real estate at the bottom of this page, you can see compared to other real estate funds, how it has performed. And again, because we have a little bit more non-core than some of our other public funds, especially smaller public funds that don't have as much to invest in this area, they're more core oriented. We tended to have a little bit more negative or below median rank, as you see in the quarter. But again, these valuations are stale. Really, the long-term analysis is more appropriate. When we look at 7 and 10 years, we've been running about median compared to other public plans. And you may recall that we did start the real estate portfolio going back to 2006, just in time really for the GFC and the real estate impact there. And because we had some more return-oriented real estate looking to get a better return than core. Some of those early years had us a bit under peers during that time, but you can see when you go back at individual years to the right on this particular row, 2019 had an 8.7% rate of return, 11 for 2018, 11 for 2017, 2016 in that same ballpark, just over 10, and almost 16% in 2015. This has been a very good value add for your portfolio, but don't put a lot of stock or comparison in the quarterly numbers, again, because valuations are very stale. The last point before I'm going to turn it over to Jim, who's going to talk about a couple of managers and how they performed in up versus down markets. I thought I'd just point you to page 24, John, if you could move ahead just a few pages. You know, one of the things that was on the agenda is just to look at that U.S. equity portfolio and how are we doing well, where do we need to look at the program. And this is just one I wanted to point out. Generally, it has been tough in mid-cap and in large cap to find managers that outperform. We're largely indexed in large cap, but we do have a few active managers. In mid cap, it's been very difficult to outperform that benchmark and to select managers. In small cap, you've actually had some very good longer term results here. If you look at 3 and 5 years, and the rankings are very good. You've got some successful managers you've been with for a very long time, like Von Nelson, for example, that have really proved their value over time. But I just wanted to point to this page before Jim went to his conversation about up market versus down market performance, and just point out that for many investors, as they look at this particular performance report for their plans, are realizing again how hard it has been to outperform the benchmarks in U.S. equity. And many are considering, should I be active at all in large cap and mid cap, but reasserting that probably in small cap, it definitely makes sense to continue to pursue active management because it tends to be a much less efficient marketplace. There's less information known about the companies that are in that benchmark compared to the S&P. So with that, I will stop, see if there are any questions on just the couple pages I've gone over, and turn it over to Jim after your questions so he can give you a couple of examples.
Any questions about Becky's part of the presentation? You'll see some of this echoed when the staff talks about the equity composite review, and you'll see that the comments that we've made jive, I think, very closely with what you'll hear from the staff. The board, and particularly Jack, asked to essentially have a little discussion, almost an education discussion about the issue of upside downside capture, which is one of the things we look at. It's one of the main features or characteristics or metrics that we look at to try to gauge what the nature of an investment product is and the way it's run. So if you could turn, John, to page 56, the upper left-hand title is JP Morgan on 3030. It's one of your managers. We'll talk a little bit about the quarter and about what upside down capture is meant to measure and what implications can be drawn from it. So we have it up there. That's tremendous. So first of all, let's talk about what upside downside capture is. The second panel down, right-hand side, it says up markets, down markets over 10 years. So this is something, one of probably 20 statistics we look at to try to get a handle on what type of manager and investment product manager they are and what type of investment product it is. And as you can see, what this measures is that every time that there's an up month, it's put in one category, up month in the market or in the benchmark market that this manager operates in. And every time there's a downside month, it's put in another bucket. And you can see the two buckets left and right. The manager's performance on average over the up months is then compared to the benchmark's performance that measures the universe that they operate in. Similarly, on the right-hand side of that box, you'll see the manager's performance versus the performance of the benchmark. In this case, over a 10-year period, which is pretty long, and this product has a pretty long life to it, the manager, as you can see, has captured more than the upside when in the up months that the portfolio has been in place against the benchmark. But it's also given up more on the downside. And yet, you know, despite that, over a 10-year period, your manager, this particular manager, has outperformed its benchmark by 69 basis points. That's in the panel up above under the 10-year column. So the question then is, how did this manager do during a very unusual quarter when their universe that they invest in plummeted by 19.6%? You can see that in the quarter to upper panel, far left-hand side, where the benchmark is in red, minus 19.6%. Well, their performance fell 17.10%, less than the benchmark. So they outperformed quite nicely. And you can see that against other people, other managers investing in this same part of the equity market, they were almost top decile. So in this particular circumstance, this is kind of interesting because the long history would have suggested, if we didn't know anything, if we knew at the beginning of the quarter that their benchmark universe was going to be down this much, we would have expected them to be down a little more. But for whatever reasons, they actually performed better and did not sustain quite the full losses that were in the benchmark. That's a good story. So let's look at another manager on page 58, and Becky mentioned them as one of your best long-term managers, Vaughan Nelson. Vaughan Nelson, known to be a conservative manager, higher quality generally. Again, if you look at the second panel down on the far right-hand side, what does the 10-year record tell us to expect in a quarter that showed a big decline from Vaughan Nelson's, the product that Vaughan Nelson has that you invest in, which is a small cap value product? You would have expected them to protect on the downside because the right-hand side of the up-down markets shows that over a 10-year period, in 44 down months, on average, their product has fallen less than the benchmark universe that they invest in. On the other hand, in the 76 up months, they have tended to trail a little bit. This is a quality that we often see. This is a record that we often see in high-quality, more conservative managers. So then let's turn to the question of, well, how did they do when the market collapsed in a particular quarter? In this particular case, they did quite well. They really adhered to what you would have expected given their history. Again, if you turn to the upper panel, far left-hand side, most recent quarter, their benchmark market was down almost 36%, 35.66%. And the manager, this particular manager, Vaughan Nelson, their portfolio values fell less than 30%. So they outperformed very substantially, 6.27% in a single quarter. This was a great time for a manager that had their characteristics, and you can see it again reflected in their rank of almost or solidly in the middle of the top quartile at 17th percentile. Again, that's upper left-hand side, first column. So let's do one more manager just to try to drive home the issue of how up-market, down-market expectations are used to assess how a manager did during a given period. Here's a manager, Acadian, I'm sorry, page 62, my fault. You know what, let's go to 63 because I think it is a little bit of a counterpart to what we have seen up to this date. It's Lazard, page 63. Again, one of your international managers, a value manager. Let's look at what we would have expected. And in this case, we only have a 3-year history for up-down market. So we have more limited history. But at least what that history says is that in the 13 down months, they have tended to have their values of their portfolio decline less than the market that they invest in. You can see that on the right-hand side of the up-down panel, second one down, far right, 4.32 versus 4.84. And they have tended to lag a little bit in those up months. So let's look at how they did. So you would have expected given the history that we have so far, that they probably would have outperformed in this quarter. But they didn't. Their benchmark fell 23.36%. Again, I'm on the upper panel, our left-hand side, just this quarter. But their portfolio fell 24.43%. So they actually fell 1.07% more than the universe that they invest in. And yet, interestingly enough, they are roughly in the top third. You can see that in the rank below. Top third of the managers that they compete with investing in this space, which goes to show that upside downside can be instructive and can tell you a lot about the manager, but it's not the defining characteristic. It's really a mosaic of metrics that we use to try to, and your staff uses, to try to hone in on the type of manager that they want to execute a particular active mandate. So we've given you some examples of upside downside where we got some surprises, and one that we expect performed as expected. This one is a surprise on the negative side, given the history that we've had so far. Jack, you were particularly the one that asked that question. Does that give you a sense of how upside downside capture gets utilized as one of the many metrics in assessing how a manager is doing?
Yes, that was very helpful because I thought this quarter might at least indicate to me how our managers are performing under stress. And I think it is helpful to look at that.
If there are no questions, I think that concludes our remarks, Mr. Chair. And if there are no questions, you can move on to your next agenda item.
Anything else from anybody? John, you ready to do tab 9? And you and Randy, are you there? Randy, you with us?
Yes, here I am. Morning, everybody.
Okay, so I'm going to kick off our deep dive on domestic equities here with just a few comments, and then I'll let Randy get into the details. Okay, so showing CAP here, our first slide, just noting that domestic equities is obviously our largest weighting within the overall CAP or pension plan portfolio. So it's a significant driver of our returns overall. You'll see the weighting as of 3/31 was 29%. We're probably closer to 32 today, given the run up in the market. So as we talked about, the moves in the public markets can move these weightings around considerably and very quickly in the last quarter or so here. So we've certainly experienced that. So domestic equities, when we think about them, high relative long-term returns, we still believe that the equity risk premium is going to persist over the long term. High relative volatility within this asset class, obviously, and Q1 illustrates that in great detail, as does Q2, as you'll see later. But it's not an asset class that we may want to tap to pay our benefits at certain points in time, as we saw in the first quarter. Although it is highly liquid, we can certainly sell it any given day, even during stress periods. It's pretty easy to trade in those securities, but might not be advantageous to the portfolio overall. So one of the things, and Jack's alluded to this a little bit, when we did the deep dive, we wanted to take a harder look at the domestic equity class this go round. And so prior to kind of the coronavirus happening, we had a meeting scheduled with RBK, and they were going to come and bring a bunch of team members, and we'd have a big meeting about that and some other things. That got put off a couple different times, and we finally were able to do that meeting over Zoom in mid-May, which was pretty good, I think. We had a good discussion. Randy will talk about some of the conclusions that RBK came to with kind of some of the research that they had done, as well as some of the significant changes that we've made over the last a year or two that I think are relatively consistent with those particular conclusions. Specifically kind of the reduction in active management that we've done, and Becky mentioned this in her presentation, large cap and mid cap in particular. As you know, we took some managers off the table there. And the last thing I would just kind of mention on my side of the fence is that I talked about it before. We are no longer carrying cash within the domestic equity asset class or any other asset class for that matter. So all of that cash, as we transact within any of these portfolios, I mean, there may be cash there for a day or two as we need to do trades or, fund capital calls or managers, that sort of thing. But, absent that sort of activity, cash gets swept in or out as needed into the cash portfolio, so that when you see our percentage weights in the pension plan at the end of the quarter, it should be reasonably accurate to what we actually hold, and not a bunch of cash sitting somewhere else in the portfolio. So with that, I will let Randy dive into the details here, and I will try to drive the slides. And Randy, take it away.
Okay, thanks, John. Next slide with what we've got here is this is the benchmark that we managed to within the domestic equities asset class. And the IMI stands for Investable Market Index. And when MSCI labels their equity indices and they use the IMI and call it the Investable Market Index, what that really means is that there's small cap stocks included in the benchmark. And so you can see that here with the overall characteristics. If you look down at the number of holdings at the end of the end of the quarter, there were over 2,000 holdings in the MSCI USA IMI index. And that includes a lot of the small cap stocks that I just mentioned. The characteristics there, the things to point out, I think, are that valuations there, a little bit on the high side after March. Of course, those have changed dramatically here since then. So the equity markets, this benchmark, fairly expensive at this point. Also, if you look down, the Sharpe ratio, we don't talk about that a lot in domestic equities presentations, but really what that is saying is that's a ratio that characterizes, did you, for the amount of risk you took, which is volatility determined by the annualized standard deviation.
So Randy, you're really breaking up badly here.
Really? Okay. How's that? Hello?
That's good.
That
Right
better?
there.
Okay.
Yep, thank you.
Okay, so basically the Sharpe ratio, you want to have a positive Sharpe ratio, because what that is telling you is that for the amount of risk that you're taking, the amount of volatility that is determined by the standard deviation, the annualized return that you're getting is worth it. So basically the last 15 years, if you were to buy the index, this index, it was worth the risk that you took. Next slide. This is a slide that characterizes the benchmark by economic sector. You've seen this before. The noteworthy part of this is how much information technology has taken over the benchmark. And this isn't just unique to the benchmark here, but any of the large cap domestic benchmarks have seen this phenomenon take place. And of course, a lot of that is due to the FANG stocks, as you know, and just a matter of growth outperforming value as well. So technology, almost a quarter of the benchmark. If you look down at the smaller economic sectors, you've got real estate, utilities, materials, energy. All those are traditionally characterized as value segments of the benchmark, and you can see how small those have become in relation to the benchmark. And again, that's due to largely to the outperformance of growth versus value and the big tech stocks overall. Okay, John. This is a the index by market cap. This is actually, although it looks like a pretty simple slide, it's actually pretty interesting this time around in that since we've been familiar with the U.S. IMI and have used it as our benchmark, the small caps have typically floated around 11 to 12% of the benchmark. And because of the underperformance of small caps that was so dramatic in the first quarter, it's actually dropped the weighting down below 10%, which is the first time that we've seen that since we've been working with this benchmark. Those stocks have rallied quite a bit off the bottom here since this slide, so things are more back to normal, but pretty dramatic move there within this benchmark during the sell-off. This is the cumulative returns for the last 15 years between the large caps and small caps within the benchmark, and the yellow is the small caps, of course, and you can see that over time, the several years, which is 15 years, you can see that small caps generally will outperform the large caps. There are periods of time when they do not, and recently that's been the case. In fact, if you see with this dramatic sell-off in the first quarter, the small cap cumulative return versus the large cap cumulative return within the benchmark is actually below the large caps for the first time in those 15 years. That again, as I said, has reversed largely to probably back to even here to date. So I'll take a look at performance here within the domestic equities asset class. For the slide on the left there, the left portion of the slide is total returns. Those are absolute returns, and the 1 year number down 10% year to 10 months or 12 months, excuse me. But again, that's reversed as the benchmark and domestic equities in general. The broad indices are up almost 30% off the bottom. Probably the more important thing to look at is the 10-year number, and getting almost 10% returns from the domestic equity asset class over the last 10 years on an annualized basis.
Hi, Randy, you're breaking up again.
Huh. Any suggestions by our tech people on what I should do here? I'm not doing anything different.
You're fine now. I think it's just the mic works its way closer to your mouth as you talk. So just to check on that every once in a while would be good. But you're coming through okay now.
Okay, how's that? I put it up a little higher.
There you go.
Okay. All right slide. This is what we talked about for quite a while now. And RBK talked about it earlier in the meeting here today. And we go back, John, just for a second. The relative performance there for the domestic equity asset class, disappointing right across the board there. But again, basically shows how difficult these benchmarks, particularly those that are broad benchmarks at the large cap stocks within them, how difficult they've been to beat the last several years. This slide's kind of a repeat of what Becky said, but we thought we'd put this in here, and she told the story pretty well, so I don't think I have a lot to add here. You can see the rank is consistently above our peers, and the overall return there in each of those periods is better than the average plan that's exposed to domestic equities. And keep in mind that the ranking number there is a percentile number. So say for 1 year, that's a 31st percentile out of 66 plans. So that rather than 31 out of 66, that's really about 20 or 19th or 20th out of 66 plans. So pretty good performance.
Mike again, Randy.
Pretty good performance for the pool versus the rankings. Now we drill down to the performance history of active managers. We don't have nearly the active managers that we started with several 10 plus years ago. We've culled the herd, you might say, through time, And it's been a difficult time period, particularly in large cap, as we talked about, to find managers that can outperform for us for a consistent period of time. But these numbers show the relative return for 5 years and 10 years for the managers that we do have for those time periods. Jacobs Levy isn't included here because they haven't been with us for quite this long. But you can see that the 10-year number is really pretty good with the managers that we have. Everybody's outperformed there. JP Morgan, a little bit low there, but they had been above the number. And I believe for my memory serves, for since inception, they've added value for us. That's really the hallmark of what we try and do here is we try and, do our due diligence, pick our managers, and stick with them over a market cycle and give them time to do their thing, because there's so much that can go on in the price action of stocks within the market that it takes time for a good manager, to show themselves sometimes with all the noise that's there. And I think if you talk to just about any public plan out there, if they had managers that they had found and kept and had given a performance like this over the last 10 years, they'd be pretty happy.
Mike again, Randy.
Hello? Better?
There you go.
Okay, next slide.
I turned my volume down and he comes through pretty clearly. I don't know, Dan, can you do that?
We've done that. We're just feeling our way around.
Yeah, I think
we'll get there.
What's happening is that, like Dan said, the mic keeps sliding down. So I'll try and keep my eye on it.
We'll add the IT budget to get some duct tape.
Slide 12. This is the next two slides. This slide and the next one are show the conclusions that we talked about with RVK, which we thought we put in here that are pretty noteworthy. Some of these we've known for the last several years, which is why we've had the portfolio construction that we've had largely. Some of these others that we have come out of here are actually pretty interesting as well. But again, a lot of these things confirm what we've been doing, but let's go through them here. And it really tells the story of active management as well. Active management in U.S. equity, unlikely to generate excess returns for institutional portfolios for the past 20 years. Shows how difficult it's been to find an active manager and be able to have them do their thing for you and be able to stick with them over that period of time. Next bullet, 75% of surveyed public funds with greater than $1 billion saw their U.S. equity allocations underperform the Russell 3000 over the past 10 years. So again, when you take a look at the different asset classes, domestic equities is, if it's not the hardest benchmark, it's definitely first or second to beat. And there's a lot of focus on it as well, as because the numbers are easier to follow and such. And it's been a real challenge for large cap active managers in particular over the last several years. So the conclusions also, and we've been talking about this for some time as a staff as well as RVK has, that large and mid cap stocks are highly efficient, highly correlated, and so you need to have a dispersion in the correlations of the stocks there and the valuation, so that the active manager can buy in and sell the stocks that will outperform when what they think is going to happen with the company's performance happens. And that really hasn't been the case in large and mid for some time now. It's been very difficult anyway. Although you take a look at small caps, and small caps actually have been the opposite in some respects, where there still is an ability to expose the differences in the performance of the companies and the valuations of their stocks. And RVK did an analysis on our portfolio specifically, as well as in just a lot of this industry analysis we're talking about, and they did identify that we have been pretty successful at picking active investment managers that can add value for us in small cap. Last conclusion here on this slide was that style bias and cap size bias can incur extended performance leadership cycles that are difficult to predict, and we've seen that particularly with value and small cap here in the last several years, where they both had difficulty values had difficulty versus growth, and small caps had difficulty outperforming large.
Randy or Becky or Jim, can you, I don't understand what extended performance leadership cycles are.
Randy, did you want to take a shot at that? I can do it if you like.
Yeah, go ahead, Jim. It's your slide more or less, so I'll give you a shot at it first.
So extended performance leadership means that in any particular universe, there's usually a category that in any particular period of time does better than the other categories. So for example, in real estate today, industrial real estate is on a roll because of the Amazon effect, and bricks and mortar retail is in a band. When we look at the equity market, like the quilt chart that you see in the front of your performance, the year after year, different asset classes fall in terms of their performance relative to others. There are times when certain categories end up at the top for not just 1 year, but 2 years, 3 years, 4 years. In the case of the large cap U.S. equity market, it's been growth stocks, not value. They've had a technology bent. They've been larger caps than most, and they're concentrated in a small group of names that you know. There's Bank, you know, it's Facebook, it's Apple, it's Microsoft, it's Netflix. I mean, Google. You can go on down the list. It is unusual to see a group like that dominate the market for such a long period of time. Hence the extended market cycle. And the same thing is true, by the way, with U.S. stocks versus international stocks. So these are relatively unusual because usually there's what we call regression to the mean. You know, something gets cheaper, it gets bid up, and something gets expensive, people stop buying it on the margin. But this has been, in the equity market, a kind of an unusual cycle. Randy, did I get that right? Oh, okay.
Jim?
Becky,
Okay,
Becky,
so
help me out. Did I do the right thing there?
Jim,
You
you're on
did,
an island,
Jim.
buddy.
Nothing else to add other than interactive passive studies that we've seen an extended cycle in terms of managers at the median level being able to outperform in large cap and mid cap, and that changes through time, but this is one relative to other asset classes and styles where it's been more persistent.
And so the takeaway for us is what? That we don't rely on these value versus growth or large versus.
Well, the takeaway is tough because the longer a cycle goes on, the more likely it is that regression to the mean will start to set in. Now, that said, you know, when you have something that has been going on for some time, like active versus passive, generally speaking, not all active managers have underperformed, or the FANG stocks versus the rest of the market. You know, the issue is not will it equilibrate? It will, if market history is any example, but it doesn't mean that it'll equilibrate this year or next year or even the year after. Just as an aside, we've done a look at the characteristics of these 10 stocks that have largely accounted for most of the increase in the S&P 500 in recent years, and compared them to the stocks that did the same thing in 1996, 97, 98, 99. You may remember that period. And one of the differences is that the companies this time around, which may account for the extended cycle, have real earnings. They have lots of cash flow. Many of them have lots of real cash flow. and many of them have dominant positions in their industry. So they're not as speculative as the stocks that drove the tech telecom market back then. Their fundamental characteristics are different, and it's easy to say in retrospect, oh, we should have seen that Microsoft and Facebook and Apple were different than Enron or whatever the case might be in the internet stocks. But hindsight is not worth very much. So I think that our view is that it is unwise to place all your eggs in the basket of the categories that are moving today. That's what we call the momentum bet. A lot of hedge funds are based around that. We don't think that's a good strategy for a perpetual fund. So in that respect, we would say don't abandon your allocation to international stocks, and don't abandon exposure to value stocks either.
Okay,
Thank
I
you.
think I'm back online, am I not?
You're back online, yes.
All right. John,
And
you
a
want,
little fuzzy.
John, you want to go to the next slide? Next slide, again, this is pretty much reiterates what we just talked about. Largely passive within large cap and mid cap due to the high degree of market efficiency. Active management within small cap is worth pursuing. That, of course, assumes that we have the staff to do so, which we believe we do. And, also, as Jim said, be wary of taking large positions one way or the other in style or market capitalization because of the trends that, can work against you for long periods of time. So let's take a look at our current structure. As you recall, this current structure was put in place last summer. It's a diversified approach as we've had before. It's a combination of indexed and active portfolios. We are significantly passive within large caps and have been for several years now. We did increase that somewhat last summer and significantly active within the small caps. And we have complementary active portfolios where, for instance, JP Morgan is a fundamental manager, which is the old school in looking at balance sheets, estimating earnings and such. And Jacobs Levy is a quantitative manager that looks at a lot of statistics and such.
Randy, just the mic again, please.
Yeah. Yeah. How's that?
That's better. Thank you.
Okay. And as John mentioned, we're carrying cash of less than 1% at this point.
And mid-cap, this doesn't answer. We're significantly passive in large cap and significantly active in small cap. And we are what in mid-cap?
Yeah, in mid-cap, we're all passive right now, Carl. That was one of the decisions that came out of the restructuring last summer, where we would be significantly passive in large and mid. And we actually went all passive in mid due to the fact that we were looking to reduce the number of active managers that we followed within the pool. So we do have an ETF right now that is a mid-cap ETF. It's passive investment, but we don't have any active managers there at this time. Does that answer your question?
Thank you.
Page 15, slide 15. Again, we have different types of portfolios. We have the exchange-traded funds. We have the index funds with Northern Trust and BlackRock. And our actively managed portfolios consist of enhanced index portfolios, active portfolios that imply fundamental analysis, quantitative analysis, and a couple portfolios that are long and short. Long only and partial short total is what we have. We have a couple that are partial long shorts, along with the long only portfolio as well. here they are lined up, the index portfolios.
Excuse
Yes.
me, Mr. Chairman. Question, Randy, on the, go over, long only and partial long short a
Sure,
little bit.
sure. Long only
Randy, could you mute your
portfolio.
mic before you do, please?
Well, partial long short is, or let's go with long only first, Jim. Long only is basically what you would normally think of in a stock portfolio where you're buying stocks and you're holding those stocks, okay, for the long term. Partial long short, those type of portfolios, they buy stocks and hold them as holding for the long term, but they also do some shorting of stocks in addition to that. And that's why it's called long short.
So the short, you're not intending to hold that long. I mean, it's intended, you think it's going to go up, so you're going to try the short, or you're going to get rid of it.
Yeah, the manager actually thinks the stock's going to go down, so he sells it short. And usually you don't have shorts out there for as long as you do your longs. Slide 16. Here's our portfolios again that BlackRock and Northern Trust you're familiar with. The ETFs, those are all the index type passive portfolios, which account for almost 70% now of this domestic asset class. Our actively managed portfolios are listed down below.
Deal with your mic, Randy, please.
Right. I mean, it's the same place that it was before, so I don't know what's going on, but we'll try and get through this, I guess. You can see the long-only managers that we have are DFA and Vaughn. The enhanced index portfolio, T. Rowe Price, they actually are a long-only portfolio too, but we put them to the left because of the fact that they're a little bit more specialized than just a simple long-only. And then our partial long-short managers are J.P. Morgan and Jacobs Levy. Why don't you try this instead of that? Does this work better for everybody?
Yes.
I still need the earpiece to hear. Just hold the microphone all the way back. Everybody hear me on it? Hello?
Yes.
No, I'm getting feedback.
Why don't you do the hokey pokey and turn yourself around, Randy?
I don't know. Yeah, I guess we're almost done here, so. Okay, next slide, John, please. I thought we put this slide in here to emphasize what we really try and do here as much as we can, and that's to hold managers for the long term, know them well, give them a chance to outperform over at least a market cycle in several years. And you can see that the managers that we have and have done well for us, largely through several years, we've had for quite some time. BlackRock and Northern Trust are a little bit different in that we've owned BlackRock for 15 years. We added Northern Trust just recently because we had so much in passive that we felt we should split that among managers.
Randy, Mike.
Okay. And so that's why we added Northern Trust, was to split the number of passive assets that continued to build up for us there. But again, Jacobs Levy, T. Rowe Price, DFA, Vaughan Nelson, all been with us for over 10 years. Here's the current structure as far as the positioning. Not a lot to say here. You can see down at the small cap area there, like I mentioned earlier, the benchmark weight is down to 9.7% small caps in the benchmark as of the end of March, and we had 11.9%. Still a little bit overweight in small caps, but really when you take a look at our portfolio, and RBK did their analysis on this, we're just slightly, we've been slightly value through the years, tilted towards value versus growth, and slightly towards small cap, but nothing really major. Do a lot of due diligence and monitoring here, as you can imagine, and that's per the external manager evaluation policy that we have. We have investment guidelines with every one of our managers, even the passive managers, and basically we negotiate those with the managers when we hire them, and then risk management and assists us with on our side with monitoring the managers if they stay within the guidelines. We have a manager scorecard that the analysts update every quarter on our quarterly reviews. That basically goes through the criteria that are stated in the external manager investment policy. They rate them as far as how well they're doing and come up with a recommendation to retain or not at the end of the quarter. You've heard about our quarterly review process. It's really pretty extensive. I mean, Steve and Jason put a lot of time into just building the report that we use for the quarterly reviews and going over the portfolios and making sure that everything makes sense even before we get on the call with the managers. And then, of course, we have the call with the managers. I think it's pretty detailed compared to most in the country. And then afterwards, then Jason and Steve do write-ups on the quarter, how the review went, if there's anything noteworthy there. And like I said, they do the scorecard and give their recommendation. All this comes through attribution and research that we get from our FactSet system. It's an extensive system that we use to monitor all the equity portfolios. The investment database, we use that to monitor our managers as well, but it's mostly for, seems like we use it mostly for when we get an inquiry from a prospective manager on whether we're interested in not with them and whether we want to continue to go forward and getting to know them. And we do on-site visits both for the current managers and for prospective managers. Jason has done most of that for us in the last couple of years, and it's turned out that I think, from what Jason continues to say is, it's pretty interesting to go on those on-sites and sit down with different people and just kind of get a feel. Sometimes you can get a feel for an organization just by being there, and that's what we try and do there. We do have I wouldn't say it's a written policy, but it is a known here that, we would rather not hire a manager without having an on-site with them first. That may be a challenge somewhat going forward, given what's going on, with COVID in the travel industry and such. But to date, that's been our goal, is to not hire a new manager without going through the entire due diligence process, which is basically finalized by an on-site visit. We continue to develop what we call our bench of managers. When we're not actively looking for a manager, the analysts will be doing a project where they will be reviewing a certain part of the benchmark. For instance, Steve maybe will be looking at domestic small cap, and he'll update and refresh the managers that he's looked at before that we haven't hired, that were in the finals before, that we've more or less kept track of since then, and he'll update that information and that relationship a bit. And he may as well bring in other potential relationships depending on how his due diligence goes, and if there's any interest in other managers that we haven't had on our bench. But by and large, what we try and do is we try and have a bench of 3 or 4 managers in each category, say small cap, long only, large cap, 130-30. Basically have some managers to go to that we're pretty familiar with, that if we had some type of emergency where something happened to a manager that we do have in our stable and they had to be replaced rather quickly, we could do that if we didn't want to just go to an index fund immediately. We do this with RVK's involvement. I mean, they're there for us to assist us. They'll run screens for us when we do start a new diligence project, and we'll get their opinion on, you know, who they like within the space, who they like within the space, who they don't like, and you know, we kind of take that as part of our analysis when we look at a new manager. If there is a problem with or an event with a current manager, we'll also, if we don't get prompted by them with some type of a write-up on their thoughts of, you know, how the investment sits given the changes that have happened within that investment manager, we'll also contact them and ask them about it and talk to them about it. Management fees are a really big part of public markets. I think part of it is because we pay, you know, on a dollar basis quite a bit in management fees because of the size of the pools, and domestic equities, as John pointed out, is our largest. So management fees are important, especially when active management is under fire. And so what we've tried to do through the years is to do a cost-effective approach where, you know, if we don't think it's worth spending money on active management, particularly like say in large caps, then we won't do that. We'd rather index it. And that's, you know, another reason why we have such a heavy weighting in indexing at this time, and have for several years. Our fees have been reduced quite a bit just in the last 3 years, and we'll see that on the next slide. And again, our active fees, you know, you can probably expect this to continue going forward, that the active fees that we pay for active management and the active managers that we carry are going to be more so in small caps versus the amount of money in small caps that we manage there than large caps. We monitor these fees. We keep track of them on a manager level as well as overall asset class level, and you'll see the asset class level slide here now. This is the last 3 years of management fees. The most important and readable, I guess, column is the right-hand column there, which shows you the amount of basis points that we pay overall in the domestic equity asset class. And you can see we paid 24 basis points in 2017. It increased a little bit in 2018, and that was partially due to our hiring of Jacobs Levy during the 17 and 18 year. And then 2019, we're down to 20 basis points with the new restructuring that we put in place in last summer. And that because we did go more passive, as I explained, in large cap and mid cap, and carry less active money there as well as less active managers. But I don't know how that stacks up, or if RVK has any specific data on that, how 20 basis points for domestic equity expense, but how that stacks up across the board there. But I don't know if they have any comments on that.
I don't really have any current information. When we've looked at the CEM study that you guys have done on several occasions, your equity fees have been quite good, and because of your large passive exposure, they're particularly low. It's not high on the priority list of things we worry about with respect to.
I think we are doing the CEM study again this year, right? We'll have it, yeah. We'll have results for the August meeting.
Okay, page 22 is a summary. Well diversified within the asset class. Performance has been difficult versus the benchmark. That's been no doubt about it, but substantially above average compared to our peers. I don't know if you can find a better story in what we've got. I guess there's some out there, but it's a pretty solid story given the active management environment that we have to deal with right now. We've implemented quite a few of the observations that was put forth by the RBK analysis, and I don't think that's by accident. I mean, like I said, for several years we've been going with, large caps are difficult, small caps are easier. I wouldn't say easy, but are easier to find active managers that can add value for us there. And RBK has been along with us on that. And so that's been a good thing to have this kind of reiterated this time around. We believe we have a strong due diligence process. Jason and Steve are always looking at things, and I'm always kind of surprised that they think of things I don't. So I'm like, I don't know where they come up with them, but it works pretty well. Our management fees as a percent of assets are pretty low within this asset class, I believe, and they've decreased recently, as we just shown. And finally, we're going to carry minimal cash going forward in this pool. That's a little bit different than what we've done before. We haven't carried a lot of cash at any given time in this pool. I think the max we've ever had was like 2 or 2.5%. But per the policy statement for all the asset classes going forward, there's going to be minimal cash in this asset class as well. I made it through.
So, do we have, Jim, Becky, do we have a recommendation from you that we reduce the $891 million in large cap active going forward?
Can I answer that in a larger context to follow on with Randy's comments? You have two characteristics to your equity, domestic equity performance to date. What are they? One is that they've underperformed the index, the passive alternatives. And two is that you've significantly outperformed peers trying to do the same thing. Now, I've dumped on peer comparisons at the total portfolio level. The more you get down to a more homogeneous level, the more peer comparisons matter a little bit more and tell you more, because you're all trying to do the same thing in a smaller pond that's more homogeneous, and it doesn't matter whether another fund is doing something that's half your size. They're still fishing in exactly the same, homogeneous pond. And also, you're getting to look at all of the managers that fish in the same pond. So peer comparisons matter a bit more here than they do at the total fund level. So you've underperformed the passive alternative benchmark, but you've outperformed peers. What are the 7 drivers that make for the performance of the portfolio, the domestic equity composite? One is your choice of active passive. Your performance has improved each time you've added to your passive exposure over the last couple of years. And with respect to your question, we're very supportive of more passive exposure at the large cap level. Our research says that you can outperform with active managers there, but the odds are against you. And so you have to take that into account. The second thing is this issue of the distribution. The second factor is where you decide to take active risk versus passive risk, versus passive exposure. And by the way, passive exposure doesn't mean no risk. It means you simply accept the risk of the market, which can be punishing at times, as you saw in the first quarter. Our research and our strong recommendation is active management should be targeted largely to the small cap part of your portfolio. The third thing, one of Randy's last points is that the third driver of performance is how much cash you carry. Normally, the more cash you carry, because the market over a long period of time has a positive upward bias. It has down periods, but it has been positive. Cash tends to be a drag. on the performance of the portfolio. So that's another factor in how your composite performs. A fourth factor is growth versus value. We talked about extended market performance and how growth has beat value now for the longest period of time, certainly since I've been in the market. So that's a choice that you make. And then there's the issue that Jack inquired about, which is you can color your exposure by choosing, for example, all active managers that have characteristics that protect on the downside. That's their history. It doesn't mean they guarantee they will, but you can try to slant the portfolio that way, and I call that mandate structure. You can have a theme, and the sixth factor is manager performance. And I will say that while manager performance is definitely very important, it's definitely one of the 7 factors, the portfolio's domestic equity composites that we see that perform most poorly are the ones that have a simplistic, I just want to find the best-in-class managers. That's way too simple because it leaves the other 6 drivers of performance off the table. And the last one, which Randy also mentioned, are all the operational costs. These are the most important, but also how often you change managers. Every time you change managers, the portfolio takes a hit because it costs to move from one to another. So those are the 7 characteristics. So in answer to your question, RBK would be supportive in the large cap domestic equity area of as much passive exposure as you're willing to tolerate. And we would encourage you to continue to have active management at the small cap level. Is that consistent, John, with our conversation with our team, with our respective teams? And Becky, did you have anything you wanted to add in there?
The only thing I'd say is when clients are considering moving even more substantially to passive, they've taken 1 and 2 routes. One is to just make the wholesale change over a reasonable period of time. The second is to take it as you see managers that need to be replaced, to the extent that you have active managers today and you have just a couple in large cap, that you prioritize underperforming managers, and then when there is a need to replace an active manager due to performance or other reasons, that you take that time to make the switch. So really it can be handled, in a couple of ways. We support both. Obviously, we know transition costs will always be present no matter how quickly we do it, but I wanted to mention that clients have taken a couple routes on that front.
So just to reiterate, though, we never want to leave the impression that passive exposure is riskless exposure. In fact, when you go passive, you accept the risks that are given to you by the investor marketplace, which means, by the way, heavy weights in Apple, Facebook, Microsoft. So you will be weighted in growth. You will be weighted in the higher capitalization stocks, and you will be weighted in a fairly narrow group of stocks, but one that I said in contrast to 1996 to 2000 are companies that have fundamental characteristics that are quite stronger than the other ones, but they are also more expensive. So, there will come a time when the passive index will, that more active managers will outperform it. But it's given the efficiency of that part of the equity marketplace, it's a lot harder. Even if the passive index were to be exactly met by the median manager, you would still have a more challenging time selecting managers there. Our most successful composites among our client base are those that have concentrated a lot of active management in the small cap area.
Okay, so I'm trying to figure out where we're going here.
Well, I don't know if you have a recommendation from your staff or as to what if anything, they want you to do with this information. You have delegated authority to your staff, and Becky has said there's many paths in this general direction. I would have to turn this over to John.
So let me give you a little color, Mr. Chairman, of what Randy and I have talked about and the rest of the team. So we made a fairly large change about a year ago, and you can kind of see that on slide 21, the difference in the overall weight in the large mid-cap active. I'll go back here on the overall weight there versus where we sit today. So we have taken quite a bit of active off the table, as Randy noted. At this point, we have 3 large cap managers left. One that's an enhanced index and the 2 130/30s. 2 of those have been long-time relationships, have performed relatively well for us. The other one's a little bit newer in that space. So our discussions in the kind of post having the meeting with RVK was that, we've done much of what they've suggested. Bear in mind that meeting was kind of early May-ish time frame, and so we were coming through a pretty volatile time frame where the equity markets had gotten hammered, and frankly, and even today to some degree, I'm not sure I'm favorable on running out and making another change right at this point, because it feels like when we look at some of the metrics in the market today that we see some things that there's a greater dispersion of valuations between, say, the lowest and the highest. Now that may be a little less so as we sit here today, given the very recent run-up we had, but point being is that when we look out there, there's a lot that would suggest that active management should have an opportunity, because there's such a differentiation in the market between the lowest and the highest, valued companies out there. They should have an opportunity to outperform. Now, as Jim and Becky have noted, that certainly hasn't been the case over the long term, but didn't want to go out and just pull the plug, I guess, right now is part of what I'm saying for those managers. And so I think given the changes that we already made, we would like to see how this plays out and give our managers some opportunity to hopefully show us what they can do over the next year or so. Now, if that doesn't play out well, maybe we reconsider in another year or so down the road. But we've made strides towards the passive side. As I've noted, we do have some small cap managers which they're favorable towards, and we'll certainly continue on that path, and they've done well for us. So I guess I would say more to come. We aren't bringing you a recommendation for any changes at this point in time.
I think about it very simplistically, but I'm really, really concerned that indexing has in fact created much of the momentum in the market we're seeing, and it's self-fulfilling because as those go up, you have to buy more. So it's kind of, at a very simplistic level, exactly what we're taught not to do in investing. The more expensive it is, buy more of it. So I think it's wise right now to pause. I think it's good we have, we've increased passive, because Jack, remember when we had no passive? We have made a lot of progress there. But I just have this gut feeling that the wrong time, because there will be a change at some point, and active will come back. It just may not be in our lifetime, right?
Yeah, this is Randy. I would just add that I think I mentioned it earlier that of the 3 large cap active managers that we have at this time, 2 of them, T. Rowe and JP Morgan, have actually added value for us since the time that we hired them, which means they actually outperformed the benchmark. So it's not that it's totally impossible to find a large cap active manager to do that for you, but it's really, really hard. And we actually found 2. It was, it's been, a culling of the herd, and it's been, we've gone through managers other than them, of course, but 2 of those 3 that we have now have actually proven themselves to us at this point.
Well, I think if the board is looking for a positive reason to support John's plan, it goes back to what I said at the introduction of my comments. Yes, the composite has underperformed the entire passive alternative, as have almost every institution. But your staff, to their credit, have taken those 7 factors that I went through, along with your direction in the past with respect to your preferences for passive over active, which have been built into the portfolio, and you have done much, much better than your peers. It strikes me that that your staff has executed its discretion that you've given in a way that is better than 2/3 of the peers that they compete with. So I'm always, as a consultant, deferential to CIO and their staff. They work for you 24/7, 365. We do as well, but they're here on the premises. And as Becky said, there are several paths toward where you want to be, and your staff has navigated that better than, as I say, 2/3 of the other funds out there. So I think that's a reason that John's recommendation, might be received favorably.
Jack? No, I think I'm pleased where we're at. And I think in the past we had way too many managers and we sort of replicated the S&P with extra expenses. And so now we're in a good spot. And so I would totally agree with John that there's no steps need to be done right now by this board.
That's a really good point, Jack, and it's one of the things that we talked about with RBK. In fact, it was one of the specific kind of pieces of research of how many managers are optimal. And if you have too many, you're exactly right. You're replicating the index of paying fees, and I think that's what we were doing at one point in time.
Anything else from anybody? If not, let's take a break till 11.
Randy, feel free to throw that microphone in the garbage can too.
Because that's more consistent with how we've generally referred to it, and I believe that language may be in some of the other documents that we have as well. Section 10, risk management. So this is similar to what we talked about before, and you'll see this repeatedly when we talked about the treasurer's fund. We made that change for any cash vehicle at the custodial bank rather than just the stiff vehicle that we had before. So that encompasses the interest-bearing DDA accounts, that demand deposit accounts that we had formerly done for a treasurer's account, and the next portion down there, any cash vehicle at the custodial bank, similarly allows for that DDA account. Then we changed a lot of language to be consistent with the governance policy, Constitution and Montana Code citations, custodial bank references, and the section on page 7 about the investment policy statement review to sync all of that up, and then cleaned up some of the abbreviations. So happy to answer any specific questions you have there.
Questions? If not, is there a motion to approve the changes in the Montana separately managed accounts policy?
I so move.
Terry's moves. Is there a second?
Jeff.
Jeff is second. Any further discussion? If not, all in favor say aye.
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 Any opposed? Passes unanimously.
Thank you, Mr. Chairman. Moving on to the public retirement plans policy statement. Similarly, adding the language for the custodial bank cash vehicle. As we talked about already a bit, under each asset class, removing the language under other restrictions for cash held, because we won't hold cash for any substantial length of time. In the asset classes themselves, cash will be moved into the cash asset class. This is consistent with what we already did for the real estate and natural resources in April. Schedule 2B under international equities asset class, we're just changing the emerging market securities to be plus or minus 10% of the benchmark. Previously, it was plus 10%, and we had a little bit of issue there where we had a manager that was heavily underweight and it was kind of forcing Randy to buy emerging market securities at the time. So just kind of cleaning that up. Under private investments asset class, we are moving to, and this is again consistent with what we did with real estate and natural resources, but rather than saying our limit on a single commitment can be 7.5% of the private investments asset class, just saying it's 2% of the overall pension plan. The math works out to be about the same, so it's really not a big change, but frankly, it's a much easier for me to think in terms of the weight of the overall plan. 2% weight is what we can hold in an individual commitment, and that's just easier for us compliance-wise to, I think, adhere to that. And then again, the governance policy changes and the abbreviation cleanups. Any questions on that policy?
Questions? If not, is there a motion to approve the public retirement plan investment policy?
So moved, Diane. I'll second it. This is Maggie.
Okay, moved by Diane, second by Maggie to approve the changes. Any further discussion? If not, all in favor say aye.
Aye.
Are there any opposed? Passes unanimously.
Thank you, Mr. Chairman. Moving to the trust fund investment pool. So one minor change here that I guess is a little bit more material. So as you will recall, in April, we, or I guess it would have been February, we adopted the increased allocation to the real estate asset class. And so at that time when we did that, and it's still true today, you know, the intent is to put much more into the core real estate asset class than we would in say, non-core debt-related investments. It's a little more focus on core within trust fund there. But what we ran into was as the market changed very quickly, and of course this will be a long runway that we invest in the real estate asset class. We had an opportunity in the Credo fund that we talked about, so we invested in that alongside of the pension into that particular portfolio. But it's not a core real estate investment, and so we are limited by the prior policy to 85% has to be in core. And just the timing of some of this as we kind of move along, we're not out of policy currently, but we're pretty close to that limit, and I think we probably should have at the time given ourselves a little bit more room there. And we do believe that, you know, there may be some other debt-related opportunities within real estate that we might want to participate in trust fund. Over time, we will allocate more into core real estate, but we can't get there. So we just wanted to give ourselves a little bit more latitude there with that particular restriction. The rest of the restrictions there are consistent with what we've already talked about with the other policies. So happy to answer any questions about that if you want.
So that's the change from 85 to 75 on page 12?
Yeah, yes, sorry, the very first bullet point there.
Questions? Is there a motion to approve the trust fund investment pool investment policy statements?
I would make that motion with the understanding that page 5, which is blank right now, will be eliminated.
It will. It's just because of the red line, it pushes it down. It will when we get there. Yes.
Is there a second?
Second.
All right. Jim seconded. Any discussion, further discussion? If not, all in favor of the proposed revisions to the trust fund investment pool investment policy statement, please say aye.
Aye.
Are there any opposed? That passes unanimously.
Thank you. And the last one, our state fund investment pool policy statement. So Again, changes here are all consistent with what we've already talked about, with the exception of bullet point 2. Would like to change the restriction on our weightings in triple B within state funds. So currently the way we list it is that we can hold triple Bs up to 25% of the entire state fund investment pool. It's the only restriction that we have under the investment grade portfolio where we refer to the entire state fund pool. Would like to change it to 30% of just the investment grade internal pool. It's just easier for our compliance to track it that way, because that's how we track all of our other categories. And so again, it's not really a fundamental change. It's just changing the denominator to a different level. And so we're increasing to 30%, but we're lowering the denominator, if that makes sense.
Does the math work out?
It does. It's very close. So I'll go through the example, I guess. So the internal investment grade portfolio is roughly 1.2 billion. The state fund total portfolio is roughly 1.5 billion. So we're taking 30% of 1.2 billion rather than 25% of 1.5 billion.
Okay. That math works, according to our mathematician. I guess the other question obviously is that with a state fund, run these by the state fund, run them by the state fund, and
I did not run this one by the state fund because it comes out so close that, you know, it's really not a change to the way we manage the portfolio.
All right. Anything else from anyone? If not, is there a motion to approve the revisions to the Montana State Fund investment pool investment policy?
I'll make that motion.
Jack has made the motion. Is there a second?
I'll second.
Terry seconded it. Any further discussion? If not, all in favor, please say aye.
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 Are there any opposed? That passed unanimously.
Thank you very much. That's all.
Righty then. Education. Emerging market debt education. Is that you, Jim, or is that Becky, or?
It's me. I will take that. Jim, if that's still all right with you.
Yep.
Great.
That's good. We don't want to fight here.
Plus, I'm at a disadvantage. I can't arm wrestle him virtually, so. Well, I won't take a lot of your time today, but we think this is an interesting asset class to certainly talk about in concept today. You'll see why as we go through some of the presentation. There's some unique factors about the current market environment that make it very interesting to discuss emerging market debt. So, John, if you're running the slides, if you could move to page 2 of our presentation. First is defining emerging markets. I think most people have a gut feel for what emerging markets are. There are a subset of countries that have some economic and capital market characteristics that are similar to the developed world, but they're still evolving in several important ways, such as the relative size of the markets, the liquidity of company securities, as well as how accessible markets are, especially to external institutional parties. So many people, when they're thinking of emerging markets, China usually comes right to mind because of the size of that particular market, but also India, Brazil, South Africa. These are all good examples. You can see on the map on the bottom left-hand side some of the markets that we're talking about and the primary debt issuance that they provide. In blue are the countries that are issuing debt in dollars. In green are the countries that are issuing both local and dollar-denominated debt. So there's a lot of opportunity here. Covers a good degree of the globe in terms of major regions. Some of the key facts that emerging markets, and this shocked me in preparing these remarks, constitute 70% of the world's land mass, 80% of the world's population, 40% of the world's GDP, and 60% of the world's commodities are produced in these regions. So there's some pretty powerful growth drivers behind these regions for some of the very facts that I just cited. And as such, they are expected to have elevated long-term economic growth compared to the rest of the world. So what is the investment case on page 3? Let's talk about that in a little bit more detail. We do find that looking at emerging markets, both equity and fixed income tend to have a little different return patterns than their developed cousins in equity and fixed income markets. So as a result, they tend to have a little correlation, a little lower correlation with their developed market counterpoint. And this is something we can capture in an asset allocation study and quantify. Relative to developed markets, there is the prospect for better returns over the long term. I want to emphasize that part of the point, over the long term. Because of the higher growth prospects, there's also higher risk premiums that investors expect to be compensated for some of the risk factors they do accept, and we'll talk about those in a little bit. But again, key drivers of enhanced growth in these markets and in these asset classes are the middle class is being developed and growing. This is a huge change in many of these markets where there was not a middle class before. There was only the very, very disadvantaged folks, the poor, and the very rich. The development of a middle class is a key element of creating a more developed economy. Ironically, some of the things that we see in these emerging markets is they have better rates of saving and investment than sometimes we do, which is a very interesting observation in these markets. And then also, I think a lot of times they're a little bit shortchanged in our perception of how regulations, the regulatory environment is developing. But we find a lot of favorable observations over the years that they are making steady improvements, and this helps foster a good framework for growth. Now,
Becky, what do you mean improvement in regulatory framework? Meaning they're developing a regulatory framework, or they are less regulated or more regulated?
well,
What does that mean?
Yeah, that's a great question. I think a good example can be accounting standards, although not specifically a replacement for discussing regulatory frameworks. But if you think about accounting frameworks, that the perception is that this is the wild, wild west. That companies and organizations are not as rigorous in their accounting standards relative to the developed world. And actually, we find that many of the emerging markets have adopted accounting frameworks that are the best of the developed world, and perhaps suffer from fewer of the accounting shortcomings that you find and have been, the subject of past concern. Other things that are conducive to growth is openness to have foreign investment in their economies. Going back to the 80s, there were a lot of markets that you could not enter without having a local partner, or perhaps you couldn't access the same markets that domestic or that their citizens could. And so there's a thawing of that environment where foreign investors are more welcome than they have been before. And the rules about the rule of law, as well as flow of funds, have been improving. So that's something that is an absolute necessary development for foreign investors, is they have to be able to invest. There has to be a rule of law environment so they know that investors do have some rights. But also, when you think about, as an investor, you want to be able to look at information you're getting from the prospective investment company, for example, if you're looking at a fixed income investment, and know that there is some rigor in how that information is put together. So all of those things are continuing to steadily improve. Does that help, Carl?
Yes, thank you.
Some interesting statistics at the bottom of this page. The real GDP growth by country is in the bottom left-hand side. And again, the argument for considering expanding your investment focus beyond the developed world is to access, in this case, economic growth. Of course, China has definitely been in the headlines for years as to what their actual GDP is. And of course, this is subtracting the impacts of differences in inflation. So this is real GDP growth. So the US, and obviously this was all prepared before we entered our current COVID type of environment and the recovery from it. But as we look at these differentials, comparing the US to China and India, there's a growth story here to potentially consider. And gross savings as a percentage of GDP by market, most advanced economies are out saved, if you can say that, or beat in savings behavior relative to major emerging markets, as well as other developed countries or developing countries. So there is the savings phenomenon as a percentage of GDP that exceeds the type of behavior we see in developed economies. And then the middle
Becky?
class. Yes.
Excuse me, Jim Edwards here.
Uh-huh.
I have been under the impression that China's GDP growth was a lot higher than 2.3%. And I think that's just anecdotal reading, huh?
Well, it's more than anecdotal reading. Yeah, you'll recall, and I'm sure you're remembering those articles about it being more like 7. So, and a lot of those articles that we've all read debating the real GDP growth in China were without consideration of inflation. And so this is expressed in real terms, which is some of the differential that you're seeing. But yes, I think the measurement of the actual GDP in China is something that has certainly been in the news a lot for the last several years, and speculation as to how solid these numbers are. I think that you could speculate is a real number 6, 7, or 2. In a real sense, what we do know is that it is an opportunity relative to most of the developed world. It's a great point, though.
Thank you.
You bet. The other thing that was kind of interesting here on the right-hand side is I mentioned the development of the middle class growth. And it really is exceptional in terms of what's happening in North America, where there is a very large middle class by comparison, and in the Asian Pacific regions, if you think about China and how dispersed their population is over a huge continent, and then the large distance between the folks that had the most and those that were really struggling to survive. This middle class growth is a real opportunity to consider as an investor, because as that middle class is being developed, they tend to spend money in an increasing fashion, certainly well beyond those that are just looking to survive and are considered subsistence or really struggling classes. So this is a real opportunity as well.
Becky, this is Terry. What does
Terry.
CAGR stand for?
Compound annual growth rate.
Oh, gotcha.
CAGR, we like to call it, but I didn't say CAGR. I hate that acronym. Yeah, that's the annual growth rate. So why should we think about emerging market debt as a potential opportunity in the future? It actually is, if you think about looking at every investing opportunity as what is the entire basket of opportunities available to us, and are there reasons to exclude some or consider the whole basket? emerging market debt is actually part of the basket of investments in fixed income. As you can see in the left-hand side pie charts, the first one on the left is referring to emerging market equity. You already have a participation there. It is part of the world's market capitalization in equities. The same is true of debt. So that certainly is one reason to consider it. It is part of the world basket of available investments. It is a notable amount. We do think that it does have, and we've observed it having different return patterns, so it provides diversification benefits than just investing in domestic or developed world fixed income. And it also has a better yield because investors need to and demand to be paid for the additional risk that is involved in emerging markets. So you can see what the yield to worst measure comparisons are. They're certainly above what we see here in the US fixed income world and in much of the developed world, I would say. As we all know, there's a large part of the developed world that is dealing with negative interest rates. And the Fed has certainly been asked that question more frequently here in the US and has said that's really not part of where they're looking for stimulus. But it does cause investors to say, gosh, if I can't get a lot of yield here in the US, where can I get yield? You can do it by taking more credit risk and investing in high yield and other types of securities or private debt in the US. You can also look at emerging market debt, either in local currencies, which the yield to worst figures you see here are 5.4 compared to 1.6 for the US intermediate, and emerging market hard currency. So that hard just means investing. It's usually in dollars. It's not in the local currency of the issuer. They're choosing to issue their debt, in a lot of cases sovereign debt, in another currency of a major market, and there's a lot of US issuance here. The yield to worst is 7% there. And the compound
Becky?
return, yes. Carl?
Yield to worst.
Mhm.
What is that?
That, and John can probably provide a better explanation, but that's the highest yield one would receive that would not contemplate an actual default. John, I don't know if you want to explain that in any more detail.
Well, that makes sense. It's the worst.
It doesn't make sense to me. So why don't you try it again?
Yeah. Okay, so if you bought a bond and it pays a specific coupon at 5%, it may have other features in that bond. It may have call features, other types of things, and you may not have bought it at par. But I mean, let's say we bought it at par, and it's a 10-year bond, but it's callable after 5 years. So you would look at that bond, and you might look at the call might be the worst feature. So if it got called in 5 years, you get your 5%. If it went further, you might get something more. It comes into play more when you're buying at a premium or a discount in a particular bond. But it's sort of looking at the portfolio and saying, what's the worst return I could get here? There may be upside in addition to that, but that's a metric that we commonly look at in bond portfolios.
Yeah, we think about bonds as very simple. You lend money to somebody and they pay you interest and then they give you your money back. But in fact, many bonds have call features and other options that are associated with what the borrower can do with the proceeds, including send them back to you earlier than you thought. And so a yield to worst calculation says, what if all of those features were executed in the way that was most adverse to the lender, to you, the bondholder? And that's yield to worst. So it's kind of the worst outcome you could think of. It doesn't have anything to do with, this is the worst scenario. It is associated with the features of the bond itself.
And that's assuming that you hold it to maturity. So it's not to say that during a particular quarter, if, interest rates go against you significantly, you might be in a much worse position from a, what's the market value of that particular bond? But this is assuming that you hold it to maturity or to the call. And that it's not anticipating a default of any sort.
Yield to worst is 0 always, isn't it?
If you include default, yes.
Yes.
But that's not a feature of the bond.
Right. right. So if you move to page 5, what are the risks? We've talked about some of them already, but if you look at the 2 different kinds of emerging market debt, the hard currency, which again is denominated in a currency other than the domestic currency of the issuer, and a lot of this is dollar debt, or local currency, which is kind of self-explanatory. Let's give a live example. So hard currency, Mexico issues their sovereign or government debt in US dollars. An example of local is Argentinian debt that's denominated in pesos, Argentinian pesos. So what are the key risks? Well, if you look at the Mexican US dollar bond, it's in US dollars, so the investor is not taking the currency risk. In the case of the Argentinian bond, they are. The investor is. And so when you're looking at key sources of risk for local currency, that is one of them. And one of the concerns too with local currency exposure is you can be exposed to the undisciplined monetary support, which can actually, from sovereign entities or federal reserves in other countries, that can lead to high inflation, which erodes the value of your debt. So that's one thing to consider is you're saying, well, I'm interested in emerging market debt. I have the opportunity to not take the currency exposure and just invest in dollars or other major currency, or I can look at emerging and or at the local currency level and know that I do have exposure to local central banks and whether they're taking the right monetary actions to support their economies or whether they actually produce inflation, which is damaging. Now, you can have various things happen with the debt. You can have a default. You can end up with an inflationary environment or currency depreciation environment in a local bond. We detail who's taking the foreign exchange risk, whether it's the issuer in the case of the Mexican sovereign bond, that's the Mexican government that's actually taking the currency risk. If they're issuing debt, they have local obligations in pesos, but yet the investor, when they're investing in that Mexican bond that's denominated in dollars, their home currency is dollars, the investment is in dollars, there's no currency risk. And of course, if it's a local security, you have all the risk of the bond as well as the local currency you're buying it in. So you as a US dollar investor have that exposure. If you look at the key drivers of returns, in the case of the hard currency bond, the driver really is your coupon, what happens in US interest rate changes, as well as credit spreads. And on the right-hand side, if you look at local currency, again, it's the coupon, what happens in the local country interest rate changes, and currency exchange rate changes. So a little bit different drivers of individual risk components for these two investments. But the reason many investors enter these investments collectively is to get a better income or coupon than they can elsewhere in the world. Now, if you look at emerging market debt in terms of favorable conditions versus unfavorable, you'll feel when I go through this list that we're talking about this kind of investment in the early days of when you would consider it. Why do I say that? Because some of the unfavorable conditions for emerging market debt have certainly been foremost in investors' minds. And the first one especially, and actually the last one, if you look on the right-hand side in the pink, salmon pink colored box. So risk-off capital markets. Investors, when they get scared, will drive down the price of investments that are deemed risky. This means equities. This means emerging market equities. It means high yield bonds, and it means emerging market debt as well. Anything with perception of risk is driven down, kind of regardless of the actual attributes of that investment. So emerging market anything is actually exposed to what we call risk-off capital markets. We just are going through one right now. Geopolitical or economic disruptions that could impact a country's ability or willingness to pay back debt. Argentina comes to mind in that case. So you can get an environment where a country is going through a real difficult period, or a region is going through a real difficult period, which could impact a country's ability to repay their sovereign debt. Sovereign entities may actually enact some protectionist policies that hurts investors. That certainly is an unfavorable condition for emerging market debt. And then finally, since some of these emerging market countries are the ones that are producing commodities, if that return stream is hurt, as it has been for energy, that can be a difficult environment for that particular country. Now, if we look at favorable conditions for emerging market debt, it's a lot of the opposite things, where you've got good economic growth going on, stable outlook for growth, and that certainly is something that can be expanded to the view of investing in emerging markets. Stable inflation, if fundamentals are really driving how investments are priced, if environments are categorized by fiscal discipline, economic independence, and if you have financial markets that are functioning well, those are all favorable conditions for emerging market debt. What is happening now? Well, obviously some of the things on the unfavorable conditions have been influencing prices this year. Many things, actually, if you look at the market environment and the panic that has been in investors' minds during the COVID reaction. Certainly what's been going on with energy prices and commodities that have been depressed due to less demand because our economies have shut or slowed down. The Chinese growth story that was brought up as a question earlier certainly has led to some concerns about emerging market securities and emerging market debt as it relates to China. Is global growth actually impacted due to the COVID closures that the world has been experiencing, and now starting to hopefully move to the next steps of reopening? And then uncertainty about central banks and their skills to support their local debt market. So this has been we thought actually a very timely, and John, I know you agree, a timely time to talk about this investment and prepare and think and educate about it. But certainly we're doing it from an environment where we can see what happens to this kind of investment in a market where many of the unfavorable attributes may be taking place now. But as we look into the future, into the possibility of updating an asset allocation for ideas going forward, when we see some of the current issues in the unfavorable column being addressed, this could be something that could be additive, especially when we look at the future for our own interest rate environment in the US. To the extent which we think that we're going to be getting less return in bonds going forward, because yields are so low here in the US, you do start looking at other ways to make returns in fixed income. And emerging market debt is certainly a tool that comes to mind if you think about investors that are looking to shop everywhere for better returns in fixed income. If they have the ability to look at emerging markets, if they have the ability to look at high yield, these are certainly the times when they're thinking about that going into the future. So that was a very long-winded review of a lot of different considerations for emerging market debt, but we wanted to give you a view of what this particular part of the fixed income world looks like very broadly. And as we think about the future, this could be a tool we want to consider.
Mr. Chairman.
John, how active are you considering this?
Very.
I think it's very risky, so I'm kind of afraid of it. So at least for my education, I'd like to understand how you mitigate some of those risks.
So I think it's similar to, say, high yield. You want to pick a manager who's going to hopefully protect you a little bit on the downside. And we saw that within our managers this particular quarter. Now, that protection on the downside does not, as we saw, I mean, we're still down considerably in high yield. So it's not an asset class or an area where we would think that, as Becky pointed out, we're going to have liquidity or something during times of stress. This isn't a replacement for core fixed income in the sense that, when we hit a down market, we're going to be able to tap this to pay benefits or something. It would be an area where, we've seen some market declines in emerging market debt, and frankly, that's what makes it more interesting right now than it probably has been for a while. We've increased our allocation a little bit here at the high yield recently for similar reasons, because spreads blew out, and this is a similar thing to that. I guess to answer the question, I guess, how do you mitigate your risk? Well, you don't put all your eggs in that basket. I mean, I don't see emerging market debt ever being an extremely large weighting in the overall portfolio, but I do think it's probably a good tool in the toolkit that we might want to look at, especially as core fixed income yields have gone to, not too far off of zero in some instances. So that's the thought process there.
Just as a general rule, though, this isn't the last conversation about a topic that, in essence, when viewed alone, is a little more risky, but has higher potential return. Every institutional investor is having these conversations now because fixed income rates, plain vanilla fixed income rates, are so low. So the challenge that you have, which is why you get paid the big bucks, is you got that 7+% bogey, and you have a 10-year treasury at 0.9%. And so folks are looking at every opportunity to say, how can we close that gap? But none of them are risk-free. And the greatest protection, I would agree with John, is don't bet on any one of them to try to close that gap. And do it thoughtfully, carefully, and in a size that fits the diversification goals of the portfolio.
Mr. Chairman, question for Becky.
Sure.
I think it's for Becky, I don't know. So I'm not sure how to ask this, but along the lines of what was just being discussed, it seems like the risk for these emerging market debts is not only, the extreme of the risk is like zero return. Like if you have, for example, smaller emerging markets with these global and geopolitical issues, and you could end up like with a valueless investment. So what my point is there a threshold way to evaluate these kinds of investments that, below which you just will not go? And so to give us a comfort level that to start off with, we're going to get, we're going to get a return. We just don't know what the return is. You follow what I'm asking?
Absolutely. And bond managers are doing that very analysis that you mentioned. They're looking at not only the issuer, in a lot of cases, it could be a sovereign entity, so a government, what's the health of that country, what drives that country, what does their default history look like. Just like a domestic bond manager would do that, a manager that's looking at emerging market debt would go through that same exercise. And obviously, you have one set of analysis if you're looking at emerging market debt that's issued by governments as opposed to emerging market debt that's issued by companies. But the analogy of what a domestic fixed income manager is looking at is same thing would be happening with emerging market debt. The other risk factors that we highlighted in this presentation would be added to that analysis to figure out, given the fact that There can be a disruption, for example, in energy prices. If that's an energy dependent country, an exporter, then that needs to be factored into the investment thesis for investing in that particular bond. Now, I don't want to characterize that all of these emerging market countries are commodity producers. Some are commodity consumers and actually benefit from the things that could hurt other emerging market economies. So you can think about a fixed income manager as looking at that market basket, thinking back to that pie chart showing you how much of the world's fixed income markets are in emerging market debt, and looking at, okay, I like the yields in these securities. I know the yields are better because the risks that are involved in investing. What's the appropriate amount of risk, and which securities am I going to choose, and which countries am I going to choose investment in? Now, the thing about, there's two branches on the tree in emerging markets. The other thing that could be considered by an investor and a manager in this space is some mandates allow them to choose back and forth between US dollar denominated issues and local. In other cases, investors say, manager, I only want you to invest in US dollar issues. I don't want to take currency exposure. So that's another level of risk control that can be introduced into this discussion. I think the big discussion with investors today is, I know I need fixed income to help with equity risk. If I want to take very little risk in my fixed income portfolio, the chances are I'm going to earn very little or nothing when it comes to coupon. I know I need to take some risk to get a better coupon. How much risk do I want to take? And if I want to take higher yields, you either go to high yield fixed income here in the US, or you look at emerging market debt. So it's just a number, it's a tool that can be considered. Fixed income managers that have the ability to shop in the US market for high yield, investment grade, or emerging market debt go through those trade-offs that I just discussed. And some clients choose an investment in a manager that can be in any one of those spaces, and you hold them accountable to making that decision. Other clients have said, I'm comfortable in emerging market debt. How I control the risk is how much money I allocate to this area. So it may be a very small portion of their portfolio. Others have their manager choose what sector they're going to be in.
Probably a question for John, or just an observation. We've already made decisions to be in equity of emerging markets. So we really have already chosen an asset class that is in risk-free. Although, Jack, I have that same gut level reaction, but just interesting to me that we've actually selected already the more risky. And what percent of our portfolio is emerging markets? I was just trying to look, and I'm thinking it's like 4 or something like that. Is that
I don't remember off the top of my head. And Randy or Steve or somebody, if you got that, you can chime in.
But I'm just saying we've already started on this path. So, I think we should look at it in that context.
One thing, John, I'd like to see is if you're looking at some managers, a little more of your internal due diligence, so I could get a comfort level on their history and how you're analyzing how we would pick one of those. That's a good lead into my question, I think, which is that what does the manager world look like here? Are these emerging market debt managers? Are they fixed income managers who mix this in as part of a larger portfolio? Are they country-specific managers, or dollar versus or hard currency versus local currency managers? I mean,
everything except the specific country, largely. There are, Becky can address this as well, but yes, these are managers like you have separately managed accounts with. There are fixed income managers that are global in nature that can buy emerging market debt. And you can, depending on how you write the mandate, it can be, as Becky said, I only want sovereign. I only want corporate. I'm willing to take either. I only want hard dollar US. I'm willing to do local currency, whatever the manager's product offers. So yeah, they're managers, and as a general rule, we talked about the domestic equity area. The emerging market area generally has been a favorable place for active management with a higher probability, no guarantee, but a higher probability because there's so much uncertainty and less information. But the dispersion can be substantial. If a manager makes a big bet on a Turkey or an Argentina that's not diversified within the portfolio, they can have a bad outcome, which I think kind of ties to Jack's question about the due diligence on how the manager behaves and how the product is constructed. You went through that same process with your high yield managers some years ago, and you opted, your staff opted with your blessing and direction to actually accentuate the higher quality end of a standalone risky area where, like you said, in any given week or month, a particular investment could go to zero. Missing anything, John?
Hopefully it doesn't go to zero.
Yeah.
So a few comments. Happy to share some of our due diligence with you, Jack, offline, and with the rest of the board as well. Jason's been working on some of that, and in fact has done some really nice write-ups here just really recently. So we'll get some of that to you. You know, the other thought I guess I have here, and this is a little bit more broad, is that given where core fixed income is right now, as Jim mentioned, you know, sub 1% on the 10-year, it's hard to see how we provide much tailwind to our hurdle rate of 7.5, 7 5/8. So it's hard to think that we want to hold maybe as much of that as we did going forward. And this is not a fully formed thought or recommendation at this point, just something I've been thinking about, kicking around with staff. As we go into some of these other areas like high yield, more so maybe, and EMD, these are assets where at least you are clipping a coupon. So to the extent that, let's say that EMD goes down significantly in market value, we still get a return. We get cash flow off of that in a debt sense. And that's true of other areas of our portfolio as well. And so to the extent that we can use that cash flow to pay benefits and not be in a position to sell assets during a downturn, you know, that may be a benefit to us, even though, you know, we realize a pretty significant downturn, say, in the market value, we still have that positive cash flow. And that can be true to a degree of, say, equities as well in terms of a dividend, but more so here, obviously, as you see, you know, 5 to 7% type returns. I haven't done the research deeply, but generally speaking, in fixed income, the majority of your return is based off of the coupon. So it's a thought that we're looking at, you know, kind of going forward, of how do we build some cash flow into the portfolio such that we're protected from you know, needing to sell assets at bad times when things aren't going our way.
If I could just add a couple things, John, those are exactly some points that I think are appropriate to think about. When we look at our capital market assumptions, and again, I alluded to the fact that this is just education, you really would have to look at how this would work into an asset allocation study, looking at your needs comprehensively as retirement systems and as plans generally. But when you think about high yield, we're all kind of used to that risk, you know, reminded of how risky it can be when we looked at the first quarter numbers. The actual expected return and risk is fairly similar in high yield as it is in emerging market debt, especially if you look at hard or US dollar or developed markets currency issued debt. Just to give you a couple of numbers, high yield, when we refreshed our asset allocation assumptions after the correction was experienced in March, our forward-looking return for US high yield is a 7.5% rate of return with a 10% risk. And if you look at emerging markets equity, has an expected return north of 11%, but a 25% standard deviation or risk. So when we're talking high yield, the 7.5% expected return and 10% risk is significant compared to just investment grade bonds. If you look at emerging market hard dollar bonds, the expected return is about the same as high yield, 7, and a risk of about 10. So even though it feels riskier to talk about emerging market debt, to John's point, most of the return is coming from the coupon as opposed to the market fluctuation over time, especially if you hold it to maturity and there isn't a default. And we're talking about here a risk level that's less than emerging markets equity. But again, that's talking about individual markets and characteristics. This would really need to be looked at in the lens of an overall portfolio asset allocation. I just want to give you a few extra goodies in terms of numbers to think about.
And I know you're not coming with a proposal, but
no.
Does it make any sense to come forward with any proposal until we have a clearer understanding of what COVID-19 does?
Well, Mr. Chairman, if I can add a little color to this, we've been fighting the BDS movement in the legislative world for the last 2-3 sessions. Moving forward, I think our international exposure is going to continue to be the focal point of at least my world every other year for 4 months. This will add to that. It will be a recent investment if we decide to move forward with it. So I think there is an opportunity set here, and we have to look at it because we have a fiduciary duty. But I don't think we can ignore the ESG complications that come with additional international exposures. We've gotten multiple inquiries from legislative candidates, legislators, lobbyists as to what our exposures are, where our money is located. So it's just something we need to overlay on all this, that yes, we do have challenges within fixed income and we've got to find some additional opportunity sets, but I think we need to head in eyes wide open as far as where at least the political focal point on us will be, because we can't operate completely in a vacuum.
I have a question. In the international equity deal, there was a population of 67 that we could other plans that would it be a similar population with this? I mean, are there that many folks that are doing this now?
I don't know if Becky has a thought on that, but having emerging market debt is not. You will be far from the first to have an exposure to this. There are quite a number of pension plans and other institutional investors that invest in this segment, and I think they approach it very much like John is approaching it, which is I have to look at alternatives, as Dan said. In fact, it's kind of my duty to do so, given the state of play with the expected return set by the contribution level versus what's being offered in the plain vanilla or semi-plain vanilla fixed income market. So we can get back to you with a measure of that. Becky, do you have any sense of what percentage of pension plans, public or public and corporate, that would have exposure to EMD either directly with a specific allocation or through a global bond manager? Question.
Actually, if you give me a minute or two, I will look it up while we're on the line because we have our public fund report. It will understate that emerging market debt position somewhat because in some cases, plans are allowing a manager to shop among a variety of markets that I described before. And so it may depend on what those managers' allocations actually look like and whether the plan is picking that up versus just having a dedicated allocation. But it is a mixture of all approaches, from flexible mandates where the manager can go there to dedicated. But give me a minute, I will look that up and have an answer for you.
Page 10 of your handout, you're showing that there are 29 funds that have international fixed income. So that would be both emerging market and.
Yes, yes. Yeah, it'd be a combination. And the way the universe splits out those allocations, that's one of the reasons why we do our public fund report, is because we get to ask the questions instead of the very broad questions the universe tends to reflect.
Other questions? Well, I agree that this is great and that it is our responsibility to look at this, and this is a good basic start to that, although we started sort of before, but it got mixed in with other things, didn't it? Yeah, so it's
Mr.
nice.
Chairman, this is an approved investment under our current investment policy statements. So it's a timely conversation as an education topic. I think we've got some offline work to do with the individual board members, but it is very quickly moving to front burner conversation. So we'll need some board direction here relatively quickly as to whether or not this is a place you're comfortable going, because it is further down the track than we've discussed previously.
Our next meeting is August. Are you saying that you want at the August meeting to make that decision?
I think it would be helpful if we got an indication even at this meeting if you were okay with us moving forward, because we're kind of in that process. I don't believe we'll be at the point to actually hire somebody quite that soon, but it might be in that ballpark. It's hard to say given, where, some of the, as we've noted before, some of the due diligence stuff is a little more difficult. No, probably not.
No, he's not. So that's my concern then, is that I mean, we haven't seen this thing. We haven't seen COVID play out in the Southern Hemisphere. We haven't seen what happens in places like India. I mean, we have nothing really upon which to say what are the immediate or intermediate effects of this, and that concerns me.
I have a question here too, Carl. So would this be an investment that you could have just done based upon the way that you're empowered to make investments, with the caveat that we kind of learned, whatever it was, 6 months ago, that you don't do big shit like this without letting us know? Does this fall into that category, or could you just have done this and we find out about it?
It's approved. They could have
both of those are true, Jim. So I think I could have just done it, but I think hopefully we've learned our lesson that we're not going to do that. I guess a couple maybe other comments and maybe more offline conversation perhaps to get people a little more comfortable, and that's absolutely fine. Maybe just to give you more color of where we're sort of at this point. We've gone through a process where we've looked at a pretty wide swath of managers. We've talked to RVK. We've sort of narrowed the list down to all called our semifinalists, if you will. We've got, as I mentioned, some pretty good research and due diligence that Jason has primarily headed up, and happy to share some of that with people so you can see kind of what we're talking about. So I mean, we're talking about hiring a manager who, they're broadly diversified across countries. This isn't like, they're going to be 50% Argentina or something like that, but it's not to say that they wouldn't own, some name like that, where you might individually look at those names and go, oh gosh, why are we here? Well, if it's, let's say 1% of our pension portfolio and it's 1% of their portfolio, that's not a significant weighting, and we probably own more than that in the index in our international equity weightings, as Terry pointed out. But happy to share some more of those details before, maybe we can do that offline and you can kind of come back from that, and maybe that gives you a bit more comfort level. And maybe I guess, to the point here on page 10 of kind of where other plans are, that to the extent that people own it, it looks like the median is say 0.8% of the portfolio. I mean, that's kind of what we're talking about here. It's gonna, I would envision, let's say, an EMD being, 0 to 2% in kind of the non-core. So we're not talking about, $1 billion in EMD or something. This will be a small portion of the portfolio at the end of the day, I believe.
Mr. Chair, this is Jim Hamilton. May I jump in here?
Of course.
I have both a comment sort of from an investment background, but also then a question for Becky and Jim. And the comment is, I think it's important in listening to this, all of this conversation, that this is another tool in the toolbox, used appropriately and sparingly, adds to your ability to fix the portfolio or construct a good portfolio, just as it's nice to have all the right tools for building a house. So I certainly would be in favor of making sure we have this tool and use it when it's appropriate. But what I'm hearing from most of these questions is sort of a common fear, I think, from my experience, of people looking at it as a standalone investment. And so Becky and Jim, I'm wondering if you can help us understand in a simple fashion, sort of the offsetting lack of correlation between emerging markets and other markets where, certainly choosing wrong, you could go to zero in the emerging markets, but assuming you don't choose that wrong, something that may be a negative in the emerging markets might be offset by something else we have in our portfolio that's a positive in the developed market. So is there a simple way to explain that?
Well, I'll take the first crack at that, which is from a fiduciary point of view, and I'm not offering you legal advice, I'm not an attorney, but the prudent investor rule charges fiduciaries to control the risk of the total portfolio, not the risk of every individual investment. And that it's very clear on that topic. And as the question aptly puts, sometimes the best control of the risk of the total portfolio means adding standalone risk to the portfolio where you think you'll be commensurately rewarded with return. That's different than offsetting to other risks. So with respect to emerging market equity, your bond investments and real estate investments are not very correlated with that at all. With respect to your other equity investments, emerging markets has a fairly high correlation, but not as high as, say, the EU nations would be to U.S. equity, or small cap would be domestic equity to U.S. equity. So it's a very on-point question. And as Becky said some time ago, the real assessment here to the contribution of the portfolio is really to be seen in an asset allocation, because that allocation trees up to what you as fiduciaries ought to be most focused on, which is, have we built a portfolio that is too risky, not do we have some risky investments in the portfolio. You definitely have risk. You already, as you pointed out, have lots of risky investments in the portfolio. You have no choice. Investments, in institutional investing, all investing is taking risk and getting return from it. No risk, no return. Becky, did you have anything you wanted to add?
No, I think you covered it very well, Jim. The only thing I was going to add is you can think about this area. Your biggest risk in the plan, frankly, in terms of investment volatility, is from your equity exposure. And you can think about this kind of tool, to Jim's observations, this kind of tool would be pretty similar in how much it provides some diversification with equity exposure, but it's not, a 0% correlation. It has some equity beta in it, just like high yield does. So it's very similar in that regard. And when you look at other plans and how they've implemented this, like I mentioned earlier, Some are doing it on a standalone basis and finding a manager that's an expert in emerging market debt who's making all the decisions. Some have it as part of a tool set that fixed income managers can choose among. And looking at what other plans do, there isn't any clear numbers that I could put my finger on while we're online here for emerging market debt only. But I suspect it's going to be a small percentage of the total plan as you look at the universe, probably less than 1%. But it is a tool that has some of the advantages that we talked about that fiduciaries can look at as another tool to help them build yield and return in the portfolio.
And there are riskier and less risky ways to approach an allocation here. Just as I mentioned earlier, you have an allocation in what is considered a risky area, high yield. You've chosen a particular set of managers who their history would suggest that they are at the conservative end and in terms of how they work in that universe. In the case, as Becky has explained, in the case of emerging market debt, you can decide that you'll settle for a little less return, but you'll insist on a hard dollar exposure, only US dollars. That takes the currency exposure off the table. And that's one of the big exposures, because you think about your bonds, defaulting, that's a big issue. But your bonds can not default, but the currency of a particular country that issued them can go south and that you get paid back in, and it's almost like a default. So there are riskier and less risky ways to do it, but as in everything else, there's a price to be paid for avoiding some of the risks. Fair enough, John?
All right. So anything else? Let's break for a lunch and come back at 1. Does that work? All right. That's what we'll do then. All right.